has to have a dollar bank account. And at the end of everything, that dollar bank account has to go down in value. And somewhere that Belarusian bank has to have a dollar bank account. And that dollar bank account's balance has to rise at the end by the offsetting amount. Okay? Now, the easiest way that this can occur is if they both happen to have a correspondent banking relationship, meaning they have dollar bank accounts, here with Bank of America in the middle of the plot. After all, if that's what you need to do, well then to make this payment, Bank of America just needs to debit the Azerbaijani bank's account and credit the Belarusian bank's account. That's about as easy as it would get, but that's not realistic. A more realistic sequence looks, sorry, I think I need help from IT here.
Click your stop again.
And the spacebar.
All right, I'm gonna try.
Okay, so it looks more like this. And you can see here the issue is that the Azerbaijani and Belarusian banks don't share a common correspondent. So they have to sort of weave through a chain, a sequence of interbank relationships. I happen to, just to give you the idea, I happen to pick two US dollar clears located in the US, JP Morgan and Citi, because that particular hop actually is facilitated. They can settle via the Federal Reserve. They'll have master accounts for that. But more generally, these hops all involve costs, broadly defined. There's literal financial costs, fees. There's compliance costs. There's delays. Some of the clearing decisions need to occur manually, and these banks might be located in different time zones. There's also counterparty and settlement risk, at least for the non-Federal Reserve facilitated hops here. Okay. And what Krugman's quote is essentially claiming is if you force the Azerbaijani bank or the Belarusian bank to operate through alternative chains that are not the dollar correspondent system, it might be harder. It might be longer, slower, more costly, worse. And sanctions try to cut off or at least distance these banks from their access to the US dollar correspondent network. That's how sanctions work. Okay, and so that's what this paper is going to be about, trying to measure and quantify all these things and look at how they change over time. Now, there's really four contributions that we'll make, questions that we'll ask and answer. The first is the dollar really, in fact, kind of the better and important, the most efficient correspondent banking network for firms to access compared to alternatives? And I'm going to show you yes. The dollar correspondent banking network makes many more connections than alternatives like, say, the yuan, and it does so more efficiently, more quickly, with fewer hops. Next, we're going to look at what actually happens when sanctions are deployed. Do the targets of sanctions find themselves cut off from these links, find themselves further away from the correspondent banking network, the dollar one? And again, we're going to say yes. In many cases, they're simply cut off. And when they're not cut off, the correspondent relationships that they retain are of lower quality. Sanctions do degrade the access of targets to the global payments network. Third, we want to think about what happens to banks that are not targeted, but that are in the same countries where these sanctions are deployed. It could, ex ante, in theory, go either way. You could imagine we hit a bunch of Belarusian banks with sanctions, and the non-sanctioned banks make more robust their dollar correspondent banking relationships and essentially try to preserve the country's connectivity to global payments. But that's actually not what we find. We find that even the non-targeted banks in what we'll call heavily sanctioned economies lose access to Western payment apparatus, Western payment infrastructure. But they also shift. And in particular, we'll show that they shift to a large extent to the yuan. Finally, you might say, okay, we've heard a lot of conversation about this. The media is covering this role of the dollar. Are we just documenting essentially a shift away from the dollar and euro and Western payment architecture and infrastructure toward alternatives? Our answer, at least so far, in terms of this part of the role of the dollar, is no. We actually don't find that this shift is happening on average outside of those heavily sanctioned economies. So that's where we're going. How do we do it? Well, we have data that we obtained from LexisNexis Risk Solutions. This is a private data provider that services or provides services to financial institutions that are trying to make payments. And there's really two elements of these services that we're going to make use of. The first is that they essentially tell you for any given bank, for any given currency, where can that bank receive payments? In other words, it's like a yellow pages, a phone book for the people old enough in the room, for which banks have which correspondent banking relationships in which currencies. So we put this all together to create essentially a map of the global correspondent banking network, currency by currency. The next thing that LexisNexis offers its clients is an indicator variable to flag whether any given bank is under sanction, covering OFAC, which is the US sanction authority, also the EU and HMT, which are the European and British sanction bodies. The idea being that obviously they want customers to know whether they have to be extra careful, whether they're potentially exposing themselves to sanctions risk. And this reflects both kind of public announcements by OFAC and others on who's sanctioned, but also some proprietary work to do things like flag when an unsanctioned entity has, let's say, beneficial ownership from a sanctioned entity, that kind of stuff. And we cover, we'll focus in what I show you on EMDE, Emerging Market and Developing Economy Financial Institutions, since that's where the sanctions action is. There's about 17,000 of them in our data. And our data covers 21 to 25, 2021 to 25, which is a great 4 or 5 year period to capture because it's been a period when financial sanctions have really proliferated. This time series just shows the count. I'll focus on the black line, which just says the count of banks that are sanctioned by any of those three authorities. And you can see it grows by almost 50%, I guess 40%, from about 200 in a late month of 2021 till closer to 300 toward the end of 2025. So this is kind of what we're going to be doing. What's the first finding I had mentioned? I had claimed that the dollar we show, correspondent banking network, is much more useful. It's much more efficient. It's a much better connector for firms around the world than most of the alternatives. And the euro is right up there with the dollar. But let's focus on Western payment systems versus, let's say, the yuan. But the paper also covers other currencies like the pound and the ruble, et cetera. And I'm going to show you a bunch of characteristics that make that so. So first, if you just look at banks that report any correspondent relationships and ask how many have dollar correspondent relationships, 90% say yes. You ask how many have euro correspondent relationships, 10 minutes?
Yeah. Started 5 minutes late.
Almost 90% say yes. Yeah. Right. The yuan, much less, 34%. Okay. Things like how many cross-border relationships can be made by the dollar network versus the yuan network, it's about 5 times more. So there's 5 times more bank I to bank J cross-country paths that the dollar can connect and the euro can connect compared to the yuan. Of those that can be connected, they're shorter with the dollar. 2.9 hops versus 3.2 for the euro and 3.7 for the yuan. Okay, so the bottom line is all of these factors show that the dollar and euro correspondent networks offer much better connectivity than the yuan does, for example, and cutting off that option, eliminating access to that tool is exactly what sanctions are meant to do. So finding 2 then shows that they in fact do succeed in doing that. So here there's a bunch of characteristics of the value from a payments infrastructure where I'm going to compare summary statistics of eventually sanctioned banks before being sanctioned, that's pre, versus eventually sanctioned banks after being sanctioned, that's post. And again, the paper covers a bunch of currencies, but I'll focus on these three here. Let me start by you can see that the share that report dollar and euro correspondent banking relationships falls pretty severely from almost 85–90% for the dollar and the euro to about a quarter after being sanctioned. And interestingly, it's not just Western relationships that are severed. Note that even the yuan, the share that reports correspondent relationships plunges from 67 to 18%. And it's not just that banks that are sanctioned lose access. The quality of whatever remains is significantly degraded. So you can do things like measure with what they're left with. What's the minimum number of hops to get to their top 5 trading partners? And you can see the distances in terms of hops all increase quite substantially from pre versus post. Another feature of the correspondent banking relation network that I won't have much time to focus on here, but is that it's very concentrated in key hubs. A small number of hubs are really essential for the connectivity that the whole network provides. And we measure this using what are called page rank values. This you might remember from Google's algorithm. It's actually named after Larry Page. That's the page and page rank, but where, there's an interpretation that if you're doing a random walk along the network, what's the likelihood that you end up hitting one of these nodes? And it adds up to 100%. You can see the adding up the page ranks of the correspondence drops precipitously from pre to post for all these cases. So even if you don't lose all your correspondence, you lose the good ones. Okay. I should note that in the paper, we also do this in a way that's more sensitive to differences across countries or financial types. So we do have a lot of diff and diff analyses reported in the paper. Okay, finding number 3, I've showed you that correspondent relationships are lost when you're sanctioned, but what happens if you're in that same country and you're not sanctioned? The left side here shows the Belarusian, which is a country that experienced a big increase in sanctions during this period. What happened to their sanctioned banks? They went from having 115 correspondents in 2021 to 23 in 2025. And you can see the ones that they preserved are almost entirely the ruble ones. That's exactly what I mentioned in finding 2. But what's interesting is, even if I look at the non-sanctioned banks on the right, I also see that they really lost the vast majority of their Western correspondence as well. For instance, the dollar in blue gets wiped out. One thing I want to note here, and I'll elaborate, is that the yuan, this green bar, goes up a lot in importance among those banks. They reorient toward non-Western clearing relationships. Here's another way to see this and think about it. This is Belarus in 2021. We look at all the connections between Belarusian banks and foreign banks elsewhere around the world. And we ask, which currency offers you the shortest path to get there? So the interpretation of this blue bar here, which goes up to about 35%, is something like 35% of all possible paths emanating out of Belarus would be most efficiently done via the dollar correspondent banking network. Another 45% or so would be the case with the euro network, so it gets you up to 80%. The dollar or the euro offers Belarusian banks the best option. There's a little green bar here, about 1 percentage point, capturing the share where the yuan offers the most efficient payment route. Now I want to show you what happens when we get to 2025. You can see the dollar share collapses. Euros shrinks, but not by as much, but their combined share, falls from like 80 to less than 50%. And perhaps most importantly and most strikingly, you can see the green bar expands. It's now much wider, much taller than the dollar. The green bar is the yuan, which now provides the best connectivity for maybe a third or a quarter of the paths. Now this is Belarus, but other countries that we would consider heavily sanctioned economies show very similar patterns, certainly in terms of the expansion of that green bar. So Kyrgyzstan, Russia, Myanmar, these are countries that experience big increases in the share of their banks that are sanctioned. And they've also pivoted sharply toward the yuan by this measure. Which brings me to the fourth and last finding. You might ask, is this part of the global decline of the dollar? Is this just something we're seeing everywhere? And our answer is no. This is what it looks like if I look at other EMDEs pooled together, and you can see, yes, the yuan bar increases, but by about a percentage point. And yes, the combined dollar euro decreases, but it's trivial by about a percentage point. You can see this also in the cross section of countries. Here along the x-axis, as you move to the right, those are the countries where the share of their banks that are sanctioned has grown. And as you move up, it's the share of correspondents that are yuan correspondents. And you can see Kyrgyzstan, Russia, and Belarus, are in the top 3 of each. And in the paper, we examine alternative potential explanations for this. Like, is it about trade? And we find that no, we can't find anything else that has explanatory power like this so far. The last analysis I'll show you is we can kind of zoom out a little bit and just look at all international connections and measure something called the global efficiency of these networks. It's an inverse measure of distance. I take the distance from I to J in each of these currencies, 2 hops, 3 hops, 4 hops. I take the inverse of that and I add it up. The reason I do the inverse is that most pairs, particularly for some of these currencies, can never be reached. So you can take the inverse of infinite distance, it's 0, and now this is calculable. But the implication is a higher number means you're more efficient. You connect more banks across countries in fewer hops. And you can see the most efficient currency network by this measure is clearly the dollar, but things are pretty stable. The only real notable time series changes, you see a collapse in the ruble correspondence connectivity right after the war and the first wave of sanctions are levied. And you see the yuan actually declines a little bit before kind of recovering subsequently, potentially consistent with that reorientation I documented. So let me wrap up. We really focus on 4 things. With respect to the global payments network, I think we really document in a quantifiable and traceable over time way that the euro and dollar are better at connecting payers and payees than other correspondent banking networks. And they do so through these really key hubs, very concentrated networks. 2, we show that sanctions actually do degrade banks' access to these networks. And furthermore, in countries where there's a lot of targeted banks, the whole country really loses access to Western payment networks and pivots toward other networks like the yuan correspondent network. Finally, we show that this doesn't appear, at least yet, to be a global phenomenon. It seems to be constrained and concentrated among the heavily sanctioned economies.
Present is Oleg.
Yeah, thanks a lot. So when Jen asked me to invite to discuss the paper, I kind of found myself in a very unusual situation. I felt I had a really good excuse to say no, but I also felt I really wanted to discuss the paper, right? And so I actually found the topic very interesting and wanted to read the paper. So here I am, which is very unusual. Usually it's kind of the other way around, right? So about a year ago, I think it was May last year, I came to Chicago. Brent took me for coffee and he said, I'm coming back from DC. What are the topics that are exciting right now? And I told him, I think payment sanctions is the most. He's like, sorry, I'm already working with Gregor on that. So, what's the next exciting topic? So I knew they're working on it, and finally they have a draft. And I really think this is probably, as I say here in the first bullet point, it's probably the most understudied and important topic in economics. And kind of my discussion would be about kind of giving you a background why the topic is important, then talking about what they can do with their data and they do in the paper with their data, and sort of what their data doesn't allow them to do, but it's kind of the questions that beg to be asked after that first step of looking at the data on this payment connections, right? And so in a way, one reason why it's interesting is probably the area where there is the biggest gap between theory and practice. So when we talk about financial sanctions, economists in theory think about one thing and policymakers think about completely the other thing. And I'm going to have a slide on that. And the reason for that, it's just a very hard topic to conceptualize. Is like, so this discussion would be like an applied theories discussion of an empirical paper. So the empirics is meant to provide the details of how to actually like formalize this very abstract concept of payment systems, right? Like what's like the big question would be what's like the weak link, what's the scarce resource out there, right? Like how to model that, like what's stuff that you take out, which is the brick that you cannot replace with other things, right? And so I'll explain why I think it's difficult to answer that question. Okay, so payment systems oftentimes they arise when we talk about like financial architecture, and so then like if you do financial sanctions, you really need to think about payment systems. Um, uh, the other thing where they show up is when you talk about dollar dominance, right? Or dominance of currencies, right? And the payment systems would be one of the blocks. And I want to say a couple of words about that. So the problem why it's so difficult to think about it, it's largely frictionless along equilibrium paths. When things are fine, those things work well and we ignore them, right? So we don't put payment systems transaction costs into our macro models because we believe they're tiny, right? And so we can ignore them, but this is on equilibrium paths when things are good. But under sanctions or when there is a decoupling, and so something that we might be observing going forward is decoupling of the payment systems or decoupling of financial systems. That's when you're going to be off equilibrium paths for a while, sort of, right, before you get back. And sort of what's super interesting about it is that the sanctions episodes give you sort of like this view into how off equilibrium looks like, right? Like just before sanctions, you were in equilibrium, things were very frictionless. It looked like the cost of all the stuff or value added of the stuff was close to zero, right? Like it was competitive enough and the costs are not very high. But suddenly you realize that when you're off equilibrium, the cost of these things are very high. And then what these episodes allow you to do is how you come back to equilibrium. How fast can you create the alternative payment systems? Are the alternative payment system as efficient as the existing ones? And so the types of questions you might want to ask, is it like sort of a one-time fixed cost type of thing that like when this thing was working well, nobody wanted to pay the fixed cost of creating a parallel payment system because it's working anyways. But once it's not working, it's actually not that hard. You pay that fixed cost once, you create a Chinese payment system, a Russian payment system, and after that, you're back to the low marginal cost, right? Or maybe you persistently go to a world with like elevated marginal costs of doing business, especially if you have competing payment systems. And as long as you are within one, it's cheap. But when you need to cross, that's when it becomes expensive. And maybe we'll find ourselves in a world where like, as long as you're within blocks, it's frictionless, but crossing between blocks will become expensive. And so this is all kind of outside of equilibrium that we observed, but these types of episodes kind of give information about it. Another thing is it's very clear that this is a highly increasing returns type of thing, right? Like if there is like one bank or one system of banks that does it very efficiently at nearly zero marginal costs, everybody will be using it. You don't observe in kind of the second best use of it, right? And so the question is like, how important are increasing returns? And is it the related question, it's a different type of increase in returns. Is it enough to maintain one link, right? Like you can sever, like in case of Belarus, you severed 80% of the links, but if you have one, is it almost as good as like having 123 links, right? And so this is sort of the hard questions, and that's why it's kind of difficult to model it. So in theory, when I want to talk a little bit about financial sanctions. So in theory, when we talk about financial sanctions, first things that come to mind is like ability to borrow. But like, of course, this will only work if you're, dealing with a country that wants to borrow. If the country has lots of oil revenues and does need to borrow, like cutting it out of the borrowing market is not going to help. And so it kind of becomes uninteresting, right? The other things that we can think about is like vehicles for savings, right? And so this is typically what we're thinking, like dollar is a very special vehicle for saving. It's a safe asset, or maybe it gives you liquidity. But again, this only works if you're doing this intertemporal stuff or stuff across states of the world, right? And of course, right, doing sanctions over this stuff is like we have it in the models, we can put it in the models, evaluate how much the country will lose from not being able to borrow, from not being able to save, from not having access to safe assets. But in reality, these sanctions were in place anyways, and these were not the ones that turn out to be most interesting or binding. The ones that turn out to be most probably consequential were the payment system sanction. And that's what we don't have in the model. And the reason we don't have it in the model, it's kind of weird. It's like you're doing a transaction within a period and a given state. So it's not about intertemporal stuff, which we know how to put in the model. And it's not about like across states of the world where you need risk sharing or safety of assets or liquidity of assets in particular states of the world. It's really in a given state of the world. And sort of, I have a slide on this. So we almost never put it in macro model with the exception of transaction-based cost, transaction cost theories of money, like search theoretic models of money. There was a paper by Dever and Shi, which you guys cite, which I read it as a student, and they kind of conclude that the costs of this are so small that it's hard to explain the dollar dominance in the world if it was all about the transaction cost. But it's because in equilibrium, it's small, right? But like the question is, how does it look when you sort of deviate from equilibrium? Role of the dollar. Yeah, and so I'm going to talk about this here. So role of the dollar. So there are like this bunch of roles of the dollar. They're complementary. When we talk about dollar dominance, we're like, well, it's a safe asset. There are FX reserves in it. Trade is invoiced in dollar. There is trade financing that's in dollars. It's a fund in currency, and the banking systems work in it. The allocation of risk is a pretty clear thing. Anchoring of monetary policy. But one thing that we don't really discuss as much is the clearance of payments. And I think what's really cool about the paper, they actually kind of explain what's sort of central is like there is a clearing node within the economy is a central bank. But when you're an international thing, who's going to do the clearance, right? And this explains why it's really about the currency, because when you're going to do the clearance through the Federal Reserve, that clearance will be in dollars, and that sort of links to the role of the currency. You could have thought, well, it doesn't matter in which currency you do the clearance, right? As long as I owe you something, it doesn't matter in which units of account. But if central banks are these important nodes, and if this is what we want to put in the models, this explains why the currency or the dollar plays such a big role if the clearance through the Federal Reserve System is. And so you see how I'm getting back to like what's really the scarce resource. If we're going to model it, we need to figure out where is the decrease in returns to scale or a scarce resource, what's sort of not enough there. Okay, so here, and like this is getting to it, right? You can say that the scarce resource, it's something about messaging or information transmission, and without the information transmission, you cannot do that. But like in the end of the day, it sort of points out that there is something about clearing and clearing through a centralized system, and that's why the currency matters. And so I think this is a very useful example to think about it. So it's like you're in a given state of the world and in a given period, and you have 100 rupees in Russia. And so the exchange rate right now is 95 rupees a dollar. And so like the question is like, if you have 100 rupees in Russia, how can it be less valuable than having a dollar in the US? And oftentimes there are a lot of, like anecdotal reports and reports in the news that a lot of people and businesses and banks would prefer to have a dollar in the US over 100 rupees in Russia, right? And why is that? You'd think if it's it's a spot currency market. If somebody can get you 100 rupees, it's enough to find one person who has access to the banking system elsewhere, so that it's really the price should be 95 and not 100, right? And so, but I think this is the key question. So is it about the rupee? Is it about Russia? Is it about a dollar? Or is it about dollar in the US payment system? And so this is what I kind of want to work, and I think it's really dollar in the US what matters, right? It's like, and this is the correspondent account in the US, right? Like having dollar in Norway is not the same as having a dollar in the US banking system. Why? Because having a dollar in US banking system allows you to buy whatever you want. And scarcity, and like oftentimes, like it's related to, for example, CIP deviations. Typically, when we think about CIP deviations, there is no risk involved. It's not about risk allocation. But somehow, having a dollar in one place and a dollar in the other place is not the same thing, right? And what is it? Usually our theories point, like we model it as balance sheet constraints of the banks. But oftentimes you can find examples where balance sheet constraints don't change, and yet having a dollar in the US banking system is more valuable than having a dollar elsewhere. And so what is that scarce resource? Is it that correspondent account in the US, or like the reserve at the central bank or something like that? And so we just don't have models of that, but I think this is sort of where things are most interesting. So I have about 5, perfect. So now we can talk about this paper. So this paper has this amazing new detailed data about linkages between banks, and so which banks are sanctioned. And so really the nature of this data is the linkages, right? It's this payment linkages that you have. You know the currency, you know the location, and you know whether somebody's under sanctions or not. And so they kind of squeeze out all information possible out of the data, right? Like if you want to find any kind of characterization of what you can do with that, they do it in the paper, and they have really nice charts. But the biggest limitation, of course, is that they don't have data on quantities, values, market shares. And like going back to that question, if like all your links are severed but one, I'm much worse off, or one link is enough. And so I don't think they have the data on the quantities and values and flows. And so without that, it's very hard to answer that question. Essentially, what's the elasticity of substitution in that payment system? So the links. The links are directional, which is interesting because correspondent and respondent banks are different things. So you know the direction of the links, but you actually don't know the quantity of the flows and how the flows change, right? And like the most obvious step, of course, is to connect the stuff to the data on actual economic transaction and actual economic allocations, whether it's financial allocations or real allocations and trade or, production, employment of firms and stuff. Once they lose those links, are there any consequences for that? Okay, but what they can do with that data is get this really nice pictures, right? Like 2021, 2025, a bunch of sanctions here. You clearly see something happens in this networks of links, right? Like the big question that remains, how allocative is it? How consequential it is for first financial outcomes and then real economic outcomes? I found this picture to be most, interesting and revealing. There is a recent paper by this group of authors with Beata Javorcic, which has a very related message, but this is about trade invoicing. And so the way they sell it is like, look, all these countries are shifting to yuan. The way I would interpret it, and it's much closer to how Brent and Gregor interpreted is like, well, under normal times, nobody shifts away from dollar. Nobody does it unless you're under heavy sanctions. And once you're under heavy sanctions, you see some shifts. There's a meaningful shifts, but it's not like you're going to 100% yuan anyways. And we don't even observe like the fraction of actually transactions that are covered in that. It could be that like a single, what's the Austrian bank? I guess you kind of had to go. Yeah, Raiffeisen. Maybe Raiffeisen covers 100% of Russian transactions, and it's the only one that like kept SWIFT and stuff like that. And so, so the way I would interpret it is like this massive sanctions and the shift to yuan was mild. That's consistent, I think, how you think about this. But this is like a latent state variable, right? Like, and so like we don't know how the stuff accumulates in the background, and the shifts could be like, at first they're like slow and then they're sudden, right? And these things that accumulate in the background can lead to very swift transitions later on. So a couple of pictures that I want to show you, and I finish with this. So this is Russian exports and imports. All the sanctions were here. The only thing that you can see from this data is the collapse during the pandemic. Oil prices fell, and you see the collapse here, and you see the huge oil prices here. But this is kind of crazy how stable this was. So like when you think about payment system sanctions, what's the purpose? There are two purposes. I didn't have time to talk about one. It's like cause all sorts of financial troubles domestically, and that's like a hard thing to do, right? But if we leave that aside, the point of payment system sanctions is to make trade harder, right? And you kind of see that imports were remarkably stable, right? And so the aggregate data is like, did sanctions work or did they not? But like in the news, we were talking about payment system sanctions here a lot, that they were really damaging, but like it didn't really translate into big movements here. Of course, these are dollar values. These are maybe you have to pay a lot more dollars for the same quantity of goods. And so what you see here, same import expenditure, but fewer goods came in. But this is where you need to connect it to kind of like real output. But these two pictures, and I will finish, I find very revealing. So this is kind of crazy. This is China. The role of China, this is like essentially shares of Russian exports and imports. Exports from Russia to China, imports from China to Russia. They went from like 20% closer to 35%. What you see here, they kind of went in tandem, and they didn't have to go in tandem. And one theory is that you cannot really have a big trade imbalance when you don't have access to the payment systems effectively. Well, India provides a counterexample, right? So China became by far the biggest trade partner of Russia, more than 1/3 of trade on both sides of trade, and in a very coordinated way. But like, look at India. So all the oil is going to India. It was really difficult to find stuff to buy from India, and that's why I was talking about 100 rupees. So what you read in the news around this time is like, Russians have all these rupees, they don't know what to do with it. But apparently it didn't prevent this trade happening, right? And so what's super interesting is like, clearly the payment system caused the biggest disruption here. They were in a position to cause the biggest disruption here. But we sort of want to know the marginal kind of contribution of payment system to how much trade they actually did disrupt, right? And this is sort of the next follow-up paper that they will write will be probably on this, I'm guessing. Great paper, yeah.
Thanks. Want to take questions?
Sure. Do we first say thank you, or do you want to have that after? It was more than thank you. I'll do a quick first thing and then
Yeah,
questions.
that'd be fine.
But so first, thank you.
The mic.
I need the mic. All right.
Yeah, there's a part of the mic right here.
All right. You want me to just stand here for this part? That's fine. So thank you, Oleg. That was super helpful. And really good stuff for us to continue thinking about. One thing I guess I wanted to riff on a little bit. I like how Oleg was focusing on the possibility that the central bank's role sort of contributes to the scarce factor, and that the key thing might be having a dollar in the US. One of the things our paper pushes toward, but continues to develop in that way is to suggest that it's actually essentially your distance from being there. If you're connected to having the dollar in the US. In some sense, the best, the lowest counterparty risk and all that is to have your dollar at a bank with a master account at the Fed. But if you have a correspondent whose correspondent relationship is with that US bank that has a master account at the Fed, it's better. It's worse than having the direct one, but it's not so bad. And if you're 3 or 4 or 5 links away, it gets worse and worse, one could argue. And if you're not connected, that's the worst case. But that I agree, and that's similar to how we're thinking about things. The only other comment I'll make, I also totally agree with Oleg's point about needing to think hard about, does it matter if you lose 18 of 19 correspondents and you're left with one? How substitutable are all these? I do just want to highlight that one way we've been thinking about this is that this PageRank kind of algorithm or metric that we're using, we actually are pretty excited about the ability to tease from that the relative importance of nodes of banks without even having to see transaction quantities. The idea that there's a correspondent bank that banks all around the world are clearing their yen through or their dollars through suggests that that's a much more effective, important, and dangerous if you lose relationship than some minor bank that maybe only has you as a client. And at least that's how we're starting to think about things in the paper so far, but totally agree with basically everything that Oleg laid out and appreciate it. Sure, how about this, yes.
Hi, Amy Cooper from Virgin. There was a scatter plot where you showed on the x-axis the share of banks that became sanctioned. And I noticed that axis actually went to the negatives. So does that mean that some of the banks that you observed in the sample actually went from having sanction to no sanction? Because my question is, if you do have those banks, could we observe whether they actually re-establish link to US correspondent banks? Presumably what we care about is not just how much damage US have caused in the past, but also the ability to cause potentially more damage in the future.
The short answer is, I think most of the negatives is a denominator thing. You went from having one sanctioned bank out of 20 to having one out of 22 or 23. Part of the reason I think of that is the leftward movements are pretty small, and part is because we only observe one bank in the 4-year period that's been where all the sanctions are removed. So it really is a denominator phenomenon. Please, yeah.
I think it will be interesting to look what happens to the links, not just number of links, right? But some Russian roots in a way, and have some friends and so on. So what happened, at least in practice, it seems that Russian banks were quite good at finding or forming some other shell banks in, say, Armenia, in Russia, and so on. So you have basically now some sort of intermediaries, and well, they did build Russian payment system, so you can operate with the rubles, and then if you need dollars, you can just use this type of shell banks sort of to settle the payments if you need to. And I wonder if the data would allow kind of to see that, oh, okay, we have this correspondent bank, say in Armenia, right? And then whether there would be many more of these shell banks suddenly that would be connected to this particular correspondent bank, and also maybe again, if you extend your data and kind of would see like these shell banks, how they which have maybe banks in Russia they transact, kind of then you can see how those links are getting repaired, and maybe that would explain what Oleg showed as well. There was not so much difference, for example, on the export or import of alternative pipes. More complicated. Really,
Do you want to collect it? Yeah. Or you want to jump in? Yeah. Oh, Anil.
Cash in Chicago. I thought, Oleg, you were winding up to bring us back to like cash in advance constraints. I mean, if you wanted to be very reduced form about how to do the theory, just go back to like cloud or something where you just say that there's $1 cash in advance. You'd have to do something for the payment system. I don't know that you're going to get much farther than that. Then you'd have these 2 layers of substitution about can you substitute to a different currency, and then can you also potentially substitute to a different set of inputs? But at least then you'd be messing around with parameters that other people have tried to look at. And you could just, you could make a table like a sensitivity analysis, suppose the cost of substituting is this, that, and the other. How far to go? And also the other interesting thing is, if it's on intermediates, that also amplifies the importance of all of this. Since, you know, since we use done triple counting.
Well, I guess I came away from it with my posterior close to my prior that these things don't make much difference, which is mostly because the trade didn't change. So I am curious if you were to try to explore some real effect, if you have any ideas. I think it's very difficult because there are other kinds of sanctions and it's, you know, it's very hard to tell. But it wasn't clear, but I think another kind of fundamental piece of information is hops only increased by 1 point something. So do you have an idea like in basis points, what does a hop cost, or how much heterogeneity is there across these intermediaries in terms of the cost? Because, you know, I just can't quite get to the point of feeling like it's been shown that it matters. It's very interesting, but it's not clear about it.
Thanks, Steve Schicketti from Grandis. That was really fascinating. So thanks for doing it. I was surprised by one of your charts where you were suggesting that if the US imposes sanctions, that in some cases it looks like the Euro area or the EU is stepping in. And the reason I'm surprised is because of secondary sanctions. And so the question that, I'm not surprised that the Chinese step in, although they were trying to be very careful as well. So what do you see as the role of secondary sanctions in all of this, without getting into the ethical issues?
So I could talk about ethical issues with you.
So, can if you want.
All right, can I maybe, let me respond to some of these? Okay, and then if there's more time, let me go in the following order. I'd love to just start with the prior and posterior being similar. First thing I guess I want to just state, it's not really our paper. It's not our paper, but I think there's substantial evidence that these payment frictions are very sizable, are not negligible, are certainly on an order of magnitude of tariffs pre-2025. There are measures by firms like FXC, there's analyses by the G20. There's no really good, solid academic work quantifying this, but there are big, I would characterize them as frictions or rents. And that's one of the premises when you see a lot of these recent, kind of fintech or other sort of cross-border payment innovations. They're saying, look, this is huge. Let's grab some of that. And second, I do just want to say, I don't interpret there as being good evidence that trade hasn't changed in those countries where we saw that these huge amounts of things changed. GDP got decimated. It's hard to identify what happened. What's the counterfactual of Belarusian economic activity absent the war? But I don't want to, I do, my prior is that this stuff actually matters quite a bit, but I do agree, no, but for real outcomes, and I do agree that demonstrating that with real variables has to be done, but I don't think the opposite, it can be seen in the data in a raw or processed way. On Anil's point, which is great, I mean, Gregor and I, and Gregor, I'm sure can either do better or correct me if I get it wrong, but we're working on sort of we basically have a model that we're implementing for a second paper that has a lot of these kinds of components. And one of the core sort of costs and things that could underlie this friction is you have to pre-position liquidity to be able to make these payments. I mean, every time you have a correspondent banking relationship, you're tying up capital in that currency with that bank. And one of the reasons that gets to the increasing returns that Oleg's talking about, there's lots of elements here, but one is if I can stick $100 in a dollar correspondent account and know that that might be drawn on from Debbie and Jan and Anil, who are all doing dollar payments with me, well, then it might be more efficiently used and less frictional than if I have to do a, Slovenian current, well, that's not a good example, but some idiosyncratic currency times 3. So we are thinking about these kind of issues and we'll have something soon, I think. The two others, there was a question about sort of reconfiguration, is there a thing going from Armenia through? I do think that's in there. So when we showed things,
How to stab it?
I tried, I couldn't, I'm worried I won't be able to figure it out. But Gregor's right. It's, okay, maybe I did. But when we show things like the change in distance, well, wherever it is, we're able to see how a path from you to me,
But also, Brent, the Belarus configuration where where dollars clear, it's in, is it in, what more?
Next one,
Just the Belarus flowchart.
the Belarus flowchart.
there.
USD Kazakhstan, 3 new connections.
But
So we see where you have new connections to clear dollars in Kazakhstan that you did not, there was no USD clearing in Kazakhstan beforehand. You had a bunch of USD clearing in Russia, in Austria, this is Raiffeisen and so on non-sanctioned banks, that all goes. And you can see it in Kazakhstan, you can see it now in Kazakhstan clearing of dollars. So that's your show.
And Gregor, do you want to show how that shows up in the 2.13 to 2. I mean, that shows up in equilibrium. If you ultimately care about routing through your shells, et cetera, but to get to the same destination, which I took to be the kind of crux of your question, that's exactly what this is capturing. We can see that if you used to connect some bank in Russia to some bank in New York, and now you need to go through 3 loops, that's exactly what's showing up here. We focused on the big trade partners because Russia to New York is not as important as Russia to Turkey, but that's the idea. We see in the reconfiguration, how much further effectively are you now away from where you need to be, given you have to go through.
And some of these hops under measure stuff, because if you think about these sort of what we have on the right page rank, think of it as big hoses and very narrow pipes. Like if you have a correspondent at Citi or JP Morgan or well, so that's a huge hose. You can send as much money through it as you want without worrying about congestion or anything like that. A little bank in Kazakhstan, like you have to pre-fund stuff and they have to pre-fund a bunch of other stuff. That's, you maintain the pipe and the hop is there, but the pipe is very thin. You can't, send a couple $100 billion through there very easily. So, that sort of shows up on the, the sum of the page ranks of the other correspondents at a country level. Like the width of hoses really decreases a lot. So, that's one way we measure it. Now, is it perfect? No, but I think you get a pretty good feel that like all the thick pipes go away. But they're bigger.
No, I was just gonna say, take a minute to wrap up.
Well, the remaining question was Steve's about secondary sanctions. And, one thing I found surprising, to be honest, was the pullback from Western systems, even of non-sanctioned banks. It is possible, and even of sanctioned entities from non-Western banks. One thing that's hard to see, secondary sanctions it's a secondary sanction risk that's most salient. There's an executive order or a sanction designation under some authority. And the question is, does that authority carry secondary sanctions risk? That's different from saying, we've deployed secondary sanctions yet. And so we presume that some combination of de-risking by, let's say, New York finance and concern about secondary sanctions by the rest of the world is why you see a pullback. But
But you asked about euro, and it's not that they shift much towards the euro, right? Like everything shrinks.
Okay, that's the big point. But so then the thing is, if I looking at shares, I'm getting kind of like, getting the fact that everything shrinks.
got it. No, I think
Okay,
Gregor's answer
that's-
is the right one. Yeah.
That may be my misunderstanding.
Got it. The last thing, which we didn't spend too much time on here, is, we do see sanctions by the UK and the EU. There's not big numbers here to do a lot of teasing out, but there is a lot of correlation there. So the power to really distinguish also is somewhat limited.
Thank you, guys.
Okay,
Sure.
thank you.
You guys have the FP3 file? It's perfect. All right. So
We must not.
It's not hard.
Actually, a very good. Whether it was. It's like. Oh.
Oh, thank you. It's big enough that I can leave it
Sorry, I'll use that, however, sorry, this is.
No. Okay, ready to go?
I mean, I think
You're ready for that. So, have, Alex, take it away.
Thank you. So,
You should just go ahead.
okay, thanks so much to the organizers for including the paper. So it's called Synthetic, but How Much Risk Transfer? My name is Alex Osberghaus. I'm at the University of Zurich and incoming at SEMFI, and the paper is joint work with Glenn Shapens from the ECB, who's also in the audience over there. Okay, and because we use ECB data, the typical central bank disclaimer applies. Now, I'd like to motivate this paper with the cornerstone of bank capital regulation, the Tier 1 capital ratio. It's defined as the Tier 1 capital, so the core equity of the bank over the risk-weighted assets, which is just a sum over the product of risk weights and asset amounts. And if the bank wants to increase that Tier 1 capital ratio, it can raise equity and increase the numerator, or it can decrease the denominator. And traditionally it does that by shrinking its balance sheet through loan sales and traditional securitization. Increasingly, though, banks also reduce the risk weight, so the other factor in that denominator, in a transaction called synthetic risk transfer, or SRT. And that's going to be the topic of my talk. So it's an instrument through which banks offload the credit risk of a loan portfolio to non-banks while keeping the underlying loans on their balance sheets. So here's how it works. Imagine that, say, Deutsche Bank, which is a big player in this market, wants to reduce its capital charge in an SRT. Deutsche Bank has a corporate loan portfolio. Most SRTs happen with corporate loans. And it's going to choose out of that entire corporate loan portfolio, say, 500 corporate loans with a notional value of, say, 1 billion euros or dollars. It's going to pool those loans, and it's going to go to a non-bank investor, say a hedge fund, an insurance company, or a pension fund. And it effectively buys insurance on the first losses of this loan pool, say the first 10% of losses. Deutsche Bank will retain the senior tranche, so it's going to have to cover the losses after the first 10% in this example, right? So in reality, Deutsche Bank will also have to retain like a tiny share of the junior tranche to have some skin in the game, say like 5% off the 10%, right? But basically the bottom line is kind of the first losses are borne by this non-bank investor, and the senior tranche is kept by Deutsche Bank in this example. Now, what's very important and what makes it different to traditional securitization is that the underlying loans remain on the balance sheet of Deutsche Bank. So ownership is not transferred. Deutsche Bank will also not get any liquidity, but it does get capital relief. So, and the way it gets the capital relief through a risk weight reduction. So the risk weight before the SRT is in the ballpark of, say, like 40 to 100%. After the SRT, it's going to be substantially reduced, typically to like 0 to 15%, and on the entire loan pool of 1 billion euros or dollars. And the market for this has really grown substantially. It's actually largest in Europe. And so here I plot the stock of SRTs in Europe in the space of corporate loans alone. And you can see that it increased from 60 billion euros in 2018 to now 400 billion euros in 2026. And this is also large in relative terms, so it's almost 10% of the non-financial corporate loans in Europe. In the US, the market is still slightly smaller, but it's growing even faster, especially after, in September 2023, the Fed made a statement that was widely interpreted as now systematically allowing for capital relief for these SRTs. And therefore, we have this very strong growth also in the US. Now, despite this market size in both Europe and the US, SRTs are essentially unstudied in the academic literature, right? So we try to basically kind of shed light onto this black box of SRTs and ask the question, what are the incentives in the SRT market and the potential risks to financial stability? What we do is we study the largest SRT market, the European one, and use granular regulatory loan level data to do that. And we identify 3 channels of incentives and potential risks to financial stability. The first one comes from the selection of loans that go into the SRT. The second one comes from moral hazard. And the third one from an interconnectedness of the banks with the non-bank investors that take on the credit risk. And here's what we find. So for the loan selection, we find that banks use SRTs as a tool to reduce basically what we call the effective capitalization. So here's how they do that. We're going to causally show that banks choose capital expensive loans for the SRT. So these are loans that require a lot of capital relative to the economic riskiness. At the same time, banks don't use the SRT to become better capitalized. Instead, they're going to redeploy the free capital, meaning that lending goes up, the tier 1 capital ratio is going to stay the same, and the leverage of the SRT banks is going to go up. But this also means, because they chose the capital expensive loans, this also means that they're going to be left with the same tier 1 capital ratio, but now the capital cheap loans, which are the risky ones per unit of capital. Okay, so, and then for the moral hazard, we're going to show evidence that banks reduce the information production of the firms whose loans they synthetically transfer, which we interpret as a reduction in monitoring. And banks especially reduce the production of negative information about these firms, right? They're less likely to notice deteriorations in the credit quality. And then finally, on the interconnectedness of banks and non-banks, we find that banks tend to sell SRTs to connected investors with which they have a credit relationship. And also that investors partially finance the SRT investment with bank credit, right? And of course, this interconnectedness is relevant because we're worried that some of the credit risk may actually stay in the banking system, right? And I'm going to spend in this presentation most of the time on this loan selection and the moral hazard, and then if I have time, quickly on this interconnectedness. The other thing I want to mention is that, so these are channels that we think are very relevant for understanding the SRT market for reasons I'm going to explain in the rest of this presentation. But there may be other channels that work, some of which may actually be good for financial stability, right? So we're not going to touch on the question of whether this is good or bad for financial stability on net, right? Nevertheless, I think these are extremely relevant channels for understanding the SRT market. So what I'm going to do now is talk to you about the data and then about these 3 channels: the loan selection, moral hazard, interconnectedness. So for the data, we're going to use AnaCredit, which is the ECB's credit registry, which has basically the universe of European corporate loans since September 2018 at a monthly frequency. So with that data, we know exactly in which month, which loan is synthetically transferred, which loan is part of which transaction. And then we have very detailed data on the SRT structure and also investor participation in this market. With that, we've got a sample period from September 2018 to September 2024 monthly. We've got 90 banks that use SRTs in the sample period. Now, quickly, who are these banks? Well, they tend to be the bigger ones. And among those, they tend to be the low capitalized ones. And then we've got 350 SRTs, 200,000 SRT loans with a notional value of 200 billion euros. We've got 90 non-bank investors, of which we can identify 65 as the ultimate investors. Sometimes there's a special purpose vehicle in between, in which case we only have the name of that special purpose vehicle, but not actually the ultimate investor, right? And because most of SRTs happen with corporate loans, we actually cover more than 80% of the European SRT market with this. Okay, so let me tell you about this first result on the loan selection and how banks use that to reduce what we call the effective capitalization. So the underlying idea behind this Tier 1 capital ratio is that the risk weight more or less captures the economic riskiness of a loan, right? So that would be ideal, but very often there's not a one-to-one mapping of the economic riskiness into the risk weights. And there's basically three reasons for that. The first one is that there may be discontinuities in the risk weight estimation, right? The bank may be using the standardized approach of capital regulation, in which case these risk weights are these coarse buckets, almost irrespectively of the economic riskiness. Then there's a large literature showing that some banks underestimate the true probability of default or the loss given default, also driving a wedge between the risk weight and the economic riskiness. And then there's regulatory interventions that also drive this wedge. So how can banks use the heterogeneity in the mismatch between the risk weights and the economic riskiness in an SRT? Well, let me give you this example. So imagine a bank with just two loans, both are 100 euros. Now they said they have the same economic riskiness. They have a true probability of default of 1%, but they have different risk weights. So the left-hand side loan has a risk weight of 40% and is capital cheap. The right-hand side loan has a risk weight of 60% and is capital expensive. Further, imagine that the bank has a Tier 1 capital of 10 euros. So it's going to have a Tier 1 capital ratio of 10%. Now, it has a regulatory leverage ratio, which is just Tier 1 capital over unweighted assets of 5%. Now the bank does an SRT. We're going to causally show that it's going to choose the capital expensive loan for the SRT. And for simplicity, let's assume that the risk weight goes down to 0. So we're going to have a Tier 1 capital ratio of 25%. And because the loan actually stays on the balance sheet of this bank, we're going to have a regulatory leverage of, again, 5%, same as before. But it doesn't stop here. The bank is going to redeploy the free capital through additional lending. And because it freed the capital expensive loan, it can now do 150 euros of 40% risk weight lending for the same Tier 1 capital ratio of 10%. So effectively, the portfolio got riskier for the same Tier 1 capital ratio, and the regulatory leverage ratio, because now the portfolio is bigger, goes down, meaning the bank levered up, right? So what we're going to do is we're going to show this first part, this loan selection, where the hypothesis is that the banks choose loans with high risk weights relative to the economic riskiness. And as a sample, we're just going to use basically all outstanding loans of SRT banks in a given year and see which ones are being chosen for the SRT. Okay, so the naive approach of going about this would be to run a regression with an SRT loan dummy on the left-hand side, right? Like that captures whether or not a loan is being chosen for an SRT, and then regress this on the risk weight, and then very tightly controlling for the economic riskiness. But in reality, it's very difficult to control for the economic riskiness of a loan. So we need an experiment where we need exogenous variation in the risk weights, keeping the economic riskiness constant. And in Europe, we have a nice experiment for this. We've got the SME supporting factor, which is meant to incentivize banks to lend to smaller firms by essentially giving a discount on the risk weight for smaller firms. So here we're plotting the risk weight as a function of the firm revenue. in million euros, and you can see that the risk weights increase in the firm revenue. And then at a firm revenue of 50 million euros, you have this jump. And of course, the underlying assumption is that the economic riskiness is not going to jump up at the 50 million euro threshold, which is true based on observables. Banks also give the same amount of no loans to the left and to the right of this threshold, right? But the risk weight really jumps up, and therefore the risk weight relative to the economic riskiness. So the hypothesis is that the probability of synthetically transferring a loan also jumps up at the 50 million euro threshold, in line with the bank really caring about the risk weight relative to the economic riskiness. Okay, so we run this regression of this SRT loan dummy on these borrower revenue bins around the 50 million euro threshold. And here we plot the VA1 coefficient, and you see that in line with our prediction, the probability of synthetically transferring a loan really jumps up exactly at this 50 million euro threshold. And there's also other variations of this SME supporting factor. For example, it also depends on the bank's firm exposure, for example, and that also has implications for the probability of synthetically transferring a loan, right? We do a bunch of robustness tests and single tests and so on for this result. Okay, so that's kind of the first part of this graph. Now we show this redeployment of the free capital, and we show that the SRT is associated with an increase in lending, a decrease in the regulatory leverage ratio, and no increase in the Tier 1 capital ratio. And then the new lending is also not very capital expensive, so that's a bit of an aside, which I'm not going to show here, but in the paper. Okay, so we run these bank outcomes on the SRT intensity, which is just a measure of like how much SRTs a bank is doing, scaled by the bank size. And you can see that an SRT intensity, higher SRT intensity, is associated with loan growth. And this is really where we have like firm times quarter and bank mix effects. It's also associated with a decrease in the regulatory leverage ratio, in line with increased leverage, right? And no effect on the Tier 1 capital ratio. So banks are basically essentially left with the same Tier 1 capital ratio, but now the capital cheap loans, which are the risky ones per unit of capital. Okay, so now on this monitoring, why do we think? So I should say maybe on this first part, like why is this a very important channel for understanding the SRT market? Because it's all about capital relief, right? So it doesn't come as a surprise that they're going to optimize according to capital. Now for the monitoring, basically, why does monitoring matter in this market? Well, the loans stay on the balance sheet of the bank, so it's going to continue to be in charge of monitoring. And these loans are also arguably monitoring intensive, right? They span all industries, and they tend to go to smaller firms that don't have shareholder supervision, making creditor engagement really relevant, right? And then there's also some evidence that SRT investors are not going to step in and monitor on their own behalf. So we've got two hypotheses. The first one is at the extensive margin, that banks are going to reduce the monitoring efforts of the firms whose loans they transfer. And at the intensive margin, we hypothesize that banks reduce the monitoring more if they synthetically transfer a larger share of their firm exposure. And that captures the idea that if a bank only transfers like 50% of their firm exposure, they still have an incentive to monitor. Whereas if they synthetically transfer their entire share and they have no untransferred exposure, they may not have an incentive to monitor it anymore, right? That's what's captured by this intensive margin. Okay, as a monitoring measure, we need something that varies over time and that is bank firm specific to control for unobserved heterogeneity at this level. What we do is we use as a monitoring measure the frequency with which banks update their internal probability of default estimates. So the idea is that the true probability of default of the borrower fluctuates over time, and the bank tries to map those fluctuations into their estimates of the probability of default. And those estimates we can observe in under credit at a monthly frequency. And the idea is also that higher monitoring translates into more frequent updates because the bank is going to receive more information, it's going to request more information, it's going to go to the factories more often, and therefore it's going to be able to incorporate more information into its probability of default estimate. We capture this with two quarterly measures of monitoring. The first one is a dummy. That is one if the probability of default is updated in a given quarter. And then the second one is the standard deviation of the probability of default estimate. We validate this extensively by showing that updated probability of default estimates are actually better at predicting default, in line with the bank having more information about this firm. And then what we do is we run these two monitoring measures, basically like we do this difference in difference estimation, obviously with the endogenous treatment, right? Where beta 1 captures the extensive margin and beta 2 captures the intensive margin that I talked about. And then we've got firm times quarter and bank fixed effects. So really control, basically compare the monitoring within the same firm and quarter and within the same bank. Okay, so here's the result. Basically, so this is the extensive margin, column 1 and 2, and both measures, and intensive margin, column 3 and 4. And you can see that an SRT is associated with a up to 25% decline in the probability of default estimate updates. And for a bank that synthetically transfers its entire firm exposure, this goes up to like 35 to 70%, depending on the measure. And then we also have this asymmetry. Basically, banks reduce the likelihood of PD increases, so they're going to be less likely to capture deteriorations in the credit portfolio. Okay, in the interest of time, let me be very brief here. Basically, so the bank and the non-bank investor are very likely to be connected, right? They tend to have a credit relationship. That's what we find here. Then there's a small increase in the loan liabilities in SRTs prior to the SRT investment, in line with some partial debt financing. And this is, of course, lucrative maybe in the sense that these loans cost very little in capital that are being made to these non-bank investors, but they free a lot of capital in the SRT, right? And I'll skip this, even though there's some US implications. Happy to talk about that in the break. Scope, first academic study on SRTs, and then we capture these three channels: loan selection, moral hazard, interconnectedness. Thank you.
So the discussant is James Vickery, from the Philly Fed. And James unfortunately had a death in the family, and was already in Australia and stayed in Australia. But he was kind enough to he had already done his slides, so he recorded his discussion for us and sent us an MP4 file. So we have James in digital avatar.
You know, it's really real.
How do we know it's really him? That's the excellent stuff. We did not screen for AI and. You can look for the flickering in the image. There he is. There he is.
Also the two for the next one.
Okay, so just for those who are online, this is James Vickery from the Philly Fed, who was kind enough to provide his discussion remotely.
All right, so thanks very much to Jen and Debbie for the opportunity to discuss this really interesting paper. Before I start, I'll just give the usual disclaimer that these are my views and not those of the Federal Reserve. And I also just wanted to sort of offer my apologies that I'm not able to travel to Cambridge to be with you in person today. All right, so let's sort of dive in. All right, so I think the phrase, bank synthetic risk transfer might send maybe a shiver down the spine of people who sort of, familiar with or thinking about the events leading up to 2008. Maybe the most apt sort of comparison or, reference point from that period is to sort of think about to to think about the activities at AIG. So AIG had sort of, written a very large amount of credit protection in the years leading up to the crisis. And interestingly enough, the majority of it, at least in terms of notional values, was for sort of, in its own words, and from its 10K, regulatory capital relief rather than risk mitigation. Primarily by European banks. The primary counterparties were European banks, sort of, preparing for Basel II. So it's sort of interesting to sort of see that, these instruments were, it was prevalent during that period. They weren't the sort of key driver of AIG's collapse, but certainly I'm sure it didn't help. So fast forwarding to 2026, we've seen very rapid growth in the SRT market in recent years, and that growth, at least to some extent, has been facilitated by regulatory actions, both in Europe and in the US. Regulatory guidance, regulation has been issued that makes SRT issuance easier for banks. And I think, these developments just raise a bunch of interesting policy questions. To think about, does SRT adoption, does it increase bank risk? Does it increase or reduce interconnections and systemic risk? And, increase, how does it affect linkages between banks and non-banks? And, what are the effects on credit supply and sort of overall sort of, financial intermediation and the efficiency of the financial system? So, and with that in mind, hopefully, you should already see that, this is an important paper because this is really the first serious academic study of this important and growing market. So that alone, indicates that the paper is making a really clear contribution. And beyond that, the paper is very well executed and there's a lot to recommend it. One of the things that's great about the paper is the data. There's really fantastic data combining sort of loan level data from Anacredit where you can have, there's an SRT flag. You can see exactly when the SRT was issued, who the investor was, how much risk was transferred, and then sort of issue level data on the sort of design of each SRT issuance. There's lots of interesting evidence here. Not all of it is like exactly, the identification is not perfect for everything, but some of it is actually very well identified. And overall, this is a great paper. There's a lot of detail. It's making a very clear and significant contribution. So I really encourage you all to go and read the paper. Let me briefly summarize the main findings. So the first thing the paper finds or shows is that SRTs are used for loans that have a high regulatory risk weight relative to the sort of underlying sort of, real level of credit risk in the loan. And that I think is very intuitive, right? So like if a bank has a loan that has a high risk weight but is not actually very risky, right, then you don't have to pay a counterparty very much money to take on the credit risk of that loan, but you can, obtain a significant benefit in terms of reducing regulatory capital, required regulatory capital, which you can then sort of redeploy for some other purpose. So the paper finds, evidence exactly consistent with this and sort of, is able to shed light there. Second, the paper sort of asks, okay, having issued the SRT, what does the bank then do? What are sort of the second round effects? And basically finds that, banks use the capital relief from SRTs to expand lending, right? So there's sort of a direct effect here in terms of reducing risk-weighted assets, which increases the bank's capital ratio. But then the bank basically completely undoes that by expanding lending. So on net, the sort of tier one risk-based capital ratio is unchanged, and sort of a simple leverage ratio, which is based on total assets rather than risk-weighted assets, is actually going to decline after the SRT is issued. Third, the paper presents evidence on monitoring. So you can sort of see at the loan level, what the bank's doing in terms of like its, whether it's updating its probability of default on the loan. And basically the paper finds that banks monitor loans less intensively once they've been included in an SRT as measured by the frequency of updates of this internal PD, which is very interesting. And then finally, the paper presents evidence on the interactions between bank and non-bank, the bank SRT issuers and non-banks, and basically finds that there seem to be sort of pre-existing lending relationships between these two parties, and furthermore that the non-banks seem to fund part of their SRT investment through borrowing from banks. And that's a sort of phenomenon called round tripping, when the paper finds evidence of. The paper also has this interesting evidence that investors who are sort of non-banks who are investing in SRTs are doing so in part. They sort of require some leverage in order to implement that investment. And what the paper basically shows there is that investors in thicker tranches, which in other things equal are going to be less risky, right? So they have a lower likelihood that you're going to sort of blow through the entire tranche. Those investors tend to be more levered, right? So there's sort of a trade-off here, in my interpretation anyway, sort of a trade-off between embedded leverage and external leverage, which is quite interesting. Okay, so just to sort of give you my comments, in general, sort of the broad thrust of my comments is, I think there's a lot of richness here in the data and a lot of interesting questions. And I think what I'm going to do is sort of suggest a set of next steps for the things that the paper can now do, in terms of enriching the analysis, and in some ways kind of tighten what I see in the paper. And then I have some sort of big picture comments at the end about, what should we think about what we've learned from this paper about the systemic risk of the SRT market. Okay, so first comment, I'd like the paper to do more, to tell us more about how much tail risk the bank is actually retaining here. So the way that these SRTs work is, you're selling off a junior tranche, and the senior tranche, and sometimes the first loss is being retained by the bank SRT issuer. So the median attachment point is 15 percentage points. So there's basically the junior tranche is 15 percentage points wide. But there's a ton of variation there. So 30% of the deals sell off all the risk, some sell much less, and so forth. It's not clear to me, on net or in aggregate, like how much risk is really being transferred versus retained by the bank. And then how does that sort of division of the risk compare to the post SRT risk weight of 10 to 15%? So the bank still has to have the risk weight doesn't go to zero, it goes to a lower number. But is that number appropriate given how much risk is being transferred? Right. So if the RWA reduction is larger than the decline in the underlying risk, for example, then of course the bank has sort of excessive incentives to engage in SRTs. I think there's a bunch you could sort of do here. You could do stress tests against losses in the Great Recession, the Euro debt crisis, COVID. You could do something very complicated. I'm not suggesting you do that. You could do something simpler, and I think still it would just give us more information about the question that's really asked in the title of the paper is how much risk transfer. Right. I'm not quite sure we know the answer to that yet. So I'd like to see more. I recommend this paper by Capone et al. Does sort of a similar exercise in a lot of depth, for the sort of GSE credit risk transfer programs, which are very analogous to the instruments that are being studied in this paper. And more broadly, I'd just love to see more issue level analysis. Like, what drives the variation in the attachment point, the security design? Is it just risk? Is it bank characteristics? Is it other stuff? And just more descriptive statistics on the sort of the security issues. Second point is about monitoring. So the paper, studies, ex post monitoring and basically sort of shows that, runs a regression like this, which basically shows that, banks are less likely to update the PD once an SRT loan has been included in an SRT, once a loan has been included in an SRT. I think this is interesting evidence, and in the paper has this rich loan level data. I think it could do quite a bit more to tighten and enrich this evidence that SRT weakens monitoring incentives. The first thing I would suggest doing is to try and just trace out the timing better using an event study plot. So obviously the sort of empirical concern here is that, the timing of an SRT is not random, right? And the loans are sort of selected in various ways. What I would really like to see is that there's some discrete change in monitoring post SRT, that we don't see a sort of pre-trend in monitoring intensity before the SRT is issued, and then you see something sort of discretely changing around the time of the SRT issuance. You have this richness as like monthly loan level data, so you can really trace this out in a very fine way, and I think it'd be great to see that. The second thing the paper could do is sort of like just show us directly the informational content of the PD for the loans that have been included in an SRT. And I think a good way to do that would be to plot sort of how, trace out how PD responds ahead of default events for loans that are and are not included in SRT. So if you can sort of imagine if a bank is monitoring very actively, then you would see PD will start to rise, well in advance of when the default actually occurs. Right? But if they're not monitoring intensively, you may not see anything, and then PD is just going to jump at the time of default. Is that what you see in the data? There's this paper by Correa et al. Does something very similar to this, looking at bank supervisors and how bank supervisors take actions ahead of bank failures. I think you could do something sort of similar to that. I think it'd be very informative. And I think you could also do some stuff about sort of, whether like PDs of other banks predict, sort of Granger cause changes in PD for the bank that has the SRT. So I think there's just a lot more, you could do a lot more here that would really enrich the analysis. Third, I just wanted to say something about the role of risk weights in SRT take-up. I mean, I think this part of the paper is quite convincing. So it basically shows, you can sort of see in the graph here what the paper does. So the idea here is this graph here is plotting the risk weight for SME loans of different sizes. And you can see that there's this discontinuous jump in the risk weight at a firm revenue of $50 million. And basically what the paper's showing is that that discontinuity is also associated with an increase in the likelihood that a loan is going to be included in an SRT. So that makes a lot of sense. I would like more help to interpret the magnitudes in table 5. So not just show us that there is an effect, but just kind of like tell us the magnitude, tell us what's sort of the elasticity. And some of the results in table 5 where this is kind of studied are a bit confusing to me in the sense that the first column, which kind of pulls all the loans together, finds that basically the likelihood that a loan is included in an SRT goes up by 0.035 through this threshold, which is about a 10% change in the likelihood relative to the sample mean. So there's an effect. It's not like a huge effect. But then the other columns show that the effect is much larger when the bank firm exposure is small. And there is a reason to expect that in the sense that the size of this discontinuity, so when there's a small bank firm exposure, that's like the light blue in this graph. And you can see that the discontinuity is larger for these small, when the exposure is small, so you might expect to find a larger treatment effect. And so that in itself is not surprising, but the magnitude seems surprising, right? So this is sort of a 7-fold difference in the size of the treatment effect. There isn't a 7-fold difference in the size of the discontinuity here. So something, I just didn't quite understand that. Related to that, there's a lot of, one thing that's very striking that I found is that there's a lot of cross-country variation in SRT take-up. And this is plotted here. You can see sort of Portugal and Italy use a lot of SRT. There are a bunch of other countries that don't use it at all. Is that because of differences in risk weights? So, is it the case that, that would be one story, that risk weights are sort of too high in Portugal and Italy, and so they have very strong incentives to use SRT? I'm not sure if that's the case. It seems maybe unlikely, but, is this because of loan characteristics? Is it because of bank characteristics? Is it because of country characteristics? It's not clear. But I'd love to see more about that as well. Finally, sort of stepping back, what should we take away from this paper about whether we think that the growth of SRT represents a sort of a financial stability concern? And the paper, I think, sort of the tone, the paper doesn't take a strong stance, but I think the tone is that maybe there are some concerns here. Just to be kind of the devil's advocate, I wanted to take the other side of that and sort of argue that much of what's in the paper maybe suggests that SRTs are working well and are not such a financial stability concern. So the first point here is, the risk here is the paper shows the risk is being transferred to sort of like less systemic institutions with relatively low leverage. So that's kind of what we maybe would like, right? So credit risk is going to places where there's going to be less, sort of amplification effects through the credit cycle. SRTs are freeing up risk capital, which are used to increase credit supply. So that's kind of, we want banks to be lending and supporting economic activity, and it seems like SRTs are playing a role there. A third point is that the SRTs today, unlike the AIG instruments I talked about earlier, are generally cash collateralized. So there isn't a lot of counterparty risk for the bank. And so that's in terms of, amplification effects and, bank, non-bank interactions, that may not be such a concern. And it's possible, even with the selection effects of the paper documents, that the decline in the risk weight might be commensurate with the decline in credit risk. So it'd be nice to kind of like step back, what do we take away? It's not totally clear to me that this raises a ton of red flags about SRTs, but I think the evidence is incredibly valuable. So summing up, this is a great paper. The evidence is broadly relevant for academics and also for policymakers, not just in the EU, but also in the US and other places where the SRT market is growing and fast. And I encourage you to read the paper, and I look forward to seeing future work in this area. Thank you.
Thanks, James.
We'll let them know.
Yeah. So,
Take questions.
Craig, yeah, you're gonna
Should I would-
respond
I would-
briefly and
exactly,
then
yeah.
take questions.
I would usually ask for the slides, but I guess I'll ask for the video. So let me just, like, all the points are very well taken. Let me just say on the monitoring, basically, there haven't been a lot of defaults. So the exercise that James suggested is a bit difficult, like to look basically at kind of how like the probability of default estimates react to defaults, to actual defaults of SRT banks versus non-SRT banks, right? But I guess as the market grows, that's definitely one exercise that we should do. Happy to take questions. Sure. You.
So I think that AIG was a case where there was someone that didn't have the liquidity quickly, but it was certainly back guaranteed. And I think I worry about whether even suppose that the pricing is right, in the sense that everything is rearranged and banking system is somehow rebalanced somehow. It's still a question whether the guarantee will be honored. And I would like to understand what you mean by being cast or authorized, because it just sounds too strong. That it would
So
typically
typically,
capital to the extent of the possible loss in local data. Is that what they do?
yeah, so there's multiple ways to transfer the credit risk. One would be through like a credit linked note. Thank you. So one way to transfer the credit risk would be through a credit linked note, in which case it's going to be cash collateralized, right? They buy the note and the proceeds are stored as a deposit, which the bank can then tap into. Another way to transfer the credit risk is like through, in Europe, a lot through like what's called a financial guarantee, which is some sort of CDS, which is also funded, right? So again, cash is being put, or like highly liquid securities are being put on some deposits for the bank to tap into in case of defaults.
So I guess this seems to me very much like, if we look at the US banks, what they do is they hold a lot of securities that were issued by, you know, either NBS or something like that, where the junior tranche somebody else holds, and then the bank buys the senior tranche of a pool. How is, I mean, economically, this is the same, like, there, some banks sold a bunch of stuff in the market and then bought the senior securities back. Here, I'm selling the junior securities, but economically, it seems the same, just that Europe doesn't have an ODD market. So then they have to do some other shenanigans to get rid of this. And we see in the US, or we have, you know, also the ownership, it's not that different. The guys who buy the junior stuff get frequently funded by banks. Like, are these two phenomena different, or is this kind of sort of like the same thing, just financial engineering is a little different, given that we don't have a securitization market in Europe?
Yeah, so I hadn't thought exactly about the US case, but it'll be interesting to see basically once the US market really grows, and it is growing quite substantially, right? And those two instruments are going to coexist, and why do they coexist, right? I think that's maybe an interesting question very forward.
So I want to press you on one of James Vickery's points, and then you can ask him a question. So the one I want to press on is whether or not I should really be worried about this. This looks almost unambiguously to be like a good thing. Just to remember back, I mean, a little bit, the whole problem in Europe was the non-existence of non-bank financial intermediation. This is a way of creating non-bank financial intermediation. The problem with, one of the problems that you have with regulation in the way that we're doing it, with risk-based regulation, is that risk-based regulation is done with risk weights on an asset by asset case. On one loan, each loan gets its own risk weight. And there isn't, unless you're using internal models, which a lot of these banks are not, there isn't any credit for diversification. So now you tell me, oh, I sell this stuff off, I sell the credit risk off to somebody who is, first of all, highly capitalized, and secondly, well diversified. And even if I lend into that, where's the problem? So why is it that I should be worried? That's related to what he said at the end. I think we're going around on this issue of the monitoring. My question for you on the monitoring is whether or not the insurance sellers are pricing the fact that they know that by providing insurance, they're weakening the monitoring. I will tell you that your car insurance provider does know that. They know that you're going to be less careful. And so they price it. So is there any way to figure out if that's priced? Because if it is, again, who cares?
Yeah, so that point, that's a really good point, basically on this pricing, and I think it matters especially for the monitoring part, right? So you saw great data. One thing that's missing is basically the pricing that we currently don't have at this point. And I think for the monitoring, it would indeed be very, very relevant, right? Now, on the first point of like, why are we worried? And is this like a way to basically create like non-bank lending in Europe? Well, I think the big question is like, and this is what Jane said at the beginning, like, is the risk weight that we grant to these these banks, is it adequate, right? And does it, like, the risk weight reduction, is it adequate, and does it take into consideration the channels that we highlight in the paper, right? I think that's a question, and yeah, but it's gonna be very difficult because there's so many channels. It's gonna be very difficult to kind of capture the net effect of SRTs. That's very good.
Okay, so I'll take the other side, Steve. So one way to think about what they've done is that they've concentrated disaster risk in their portfolio. So if you have 100 loans and it has a risk weight of 10%, and I go ahead and think that that risk weight's accurate, then I've got idiosyncratic stuff diversifying it all. Once I sell the pool and then buy back the senior tranche, the only time that blows up is in the end of the world. So if you want to think about the states that can take out the banking system, and this will go for Gregor's thing too, if you buy back the senior tranche that only goes, it's exactly Cole Stafford's point about the asset-backed stuff. It's the same thing. Now it's on steroids, now it's in the bank. So I think at least you want to do something in stress testing. So I think you should at least flag that
When you don't.
no, but now they took the free capital and went into something else that's idiosyncratic. So the odds of a blow up where you said you have less capital against the state of the world where everything goes bad is what you've done. The question I had on the monitoring is it the case that the supervisors stop forcing you to update your PEs once you've securitized something, or once you've sold it off? So I don't know how often they have to do the updating just to keep the supervisors off their backs. And once it's been transferred out, they just don't do it. It's still moral hazard, but it's a slightly different model. And it might relate to the thing James had up there about whether or not the supervisory practices are very different across countries. So I think if it's true that the regulators handle this stuff differently across countries, you should see if you can exploit that.
Okay, yeah, no, thanks very much on the first point also, and then on the monitoring, so the costly the costly thing for these banks is the monitoring and not the updating of the probability of default estimates, right? So I would expect basically, if conditional on that monitoring, that they would also update the probability of default estimates, right? So that for me, it's a lot likelier than that they actually don't request information from the firm and don't list the factors and so on, then they just stop typing in some number into the system.
Can I make just a quick comment? First of all, these are all SSM banks. So the supervisory structure should be equivalent across them.
Yeah.
And secondly, my understanding, well, you can decide.
Stress tests scenarios aren't, there's all kinds of.
And the other thing is that the supervisors were encouraging this. And so again, you have to decide how you feel about that. The European supervisors are encouraging the banks to do this.
To do the SRT,
Yes,
right?
yes. There's actually.
Sure, yeah.
Active encouragement to do this. Sorry.
Thanks, great paper, Brittany Lewis at WashU. So my question is, when you're looking at the monitoring result, the SRT transfer is endogenous. So I was wondering if you can use a predicted SRT transfer by looking at predicted exposure to the discontinuous jump, and then using that predicted exposure as an instrument for SRT transfer.
Thank you very
There
much.
was one more question in the back. I can take those and then we'll.
I have a related question. It wasn't clear from the presentation that whether when the loan was originated, whether they know that the loan was gonna be part of SRO. So if it would be, then you could think that there could be differences in contracting upfront. So would that sort of mitigate the monitoring concerns that you're having? It's also really sorry for pushing on monitoring, because if the moral hazard is so severe, then you would think that the insurance companies are really gonna buy it.
Thanks very much for this point also. So what's very different between SRTs and traditional securitization is that for traditional securitization, it is in fact the case that they traditionally, like they sell the loan almost immediately after origination. For SRTs, that's not at all the case. So only after like 2 years or so, they're gonna start putting these SRTs in, putting the loans into the SRTs. And then this is a great suggestion. Thanks for this, and it's also relevant, like basically for this IB for the monitoring part. It's also relevant, I think, when we think about basically the consequences of SRTs, right? Like this increase in lending, I guess we could use the same instruments here to instrument for the SRT activity, right? Yeah,
One last
thank you.
question.
Yeah, you had a result on leverage, and I was just curious how you're thinking about that, because does this suggest that capital constraint is completely binding for European banks? If the leverage constraint is binding, would I expect to see no result on the SLG?
Yeah, definitely. So the leverage constraint in Europe is typically not binding. And you see the SRT activity mostly from banks that have low tier one capital ratios. So the more this is being used and the higher the leverage, like there's going to be this they're ultimately not going to be able to do this once the regulatory leverage ratio is fine. Yes.
Thanks very much. So we'll take a break now and come back at 3 o'clock. I'd like to.
I'm not good at it.
You know, it's the press, as people are. We have the talks around the dinner list one more time, in case you didn't see it the first time. We would welcome more people, so find it if you're. Okay, next paper will be presented by Shaheen. Perfect.
Thank you, Jen and Debbie, for including the paper on the program. This is joint work with Nicola Chettarelli, who's at the New York Fed, so the usual disclaimer applies. Capital regulation is typically designed around a single legal entity, the bank. Minimum capital requirements, deposit insurance, the core prudential toolkit all apply to that regulated entity. Yet this misses the reality that most modern banking firms are actually complex holding companies comprised of both regulated depository institutions and also lightly regulated non-bank affiliates, including broker-dealers, finance companies, and asset managers. One part of the organization is subject to the full set of prudential requirements, while the other essentially faces none of them. And these non-banks are quantitatively important. Non-banks and holding companies account for more than 25% of aggregate US non-bank financial assets. So a substantial share of what's been described as shadow banking, activities outside the regulated system, in fact, sit inside banking organizations. The question is then, what happens when regulation binds only on one side of the organization? Do tighter capital requirements on banks necessarily reduce risk at the organizational level? Or does it induce a reallocation of risk to lightly regulated non-banks within the same firm? Our evidence suggests it's the latter. When prudential standards bind asymmetrically across subsidiaries, internal capital markets become a mechanism for regulatory arbitrage. The important qualifier is that this arbitrage is internal. It's not the familiar pattern of credit migrating from regulated banks across independent shadow lenders. It occurs within a consolidated entity, which means that regulation changes where risk sits within the organization without changing how much risk the organization bears. So in this paper, we have 4 key findings. First, we find that capital moves internally. Following Basel III, banks in these organizations accumulate more excess capital while there's no change at the consolidated level. So banks are becoming better capitalized without raising external equity. Second, we observe the mechanism directly rather than inferring it. Using data on intracompany flows, we find that parents extract equity from non-banks and then inject it into the banks, while external equity issuance declines at the same time. Third, the same regulatory shock, Basel III, generates divergent outcomes within the firm. Banks become safer on every dimension, they have higher capital, better asset quality, while non-banks become riskier. And the consequence of this is that the improvement in organizational safety is considerably smaller than what the bank level numbers alone suggest. Under shocks to non-bank assets calibrated at 2008 scale losses, 4 to 6% of holding companies would completely exhaust their capital buffers that are meant to backstop the banks. So the bank level improvement in capital substantially overstates the consolidated gain once implicit liabilities to non-banks are accounted for. So first, a framework. Consider a holding company consisting of 2 subsidiaries, a regulated bank and an unregulated non-bank. Basel III raises the effective minimum to 7%. So if the bank holds 6%, now it's short of capital. The central observation is that the firm as a whole isn't short of capital. The non-bank operates with an equity to assets ratio of 60%, and the holding company is already more than compliant. So the constraint isn't the amount of capital in the firm, the quantity of capital, but it's its location. Capital sits in the entity where regulation doesn't bind, and it's scarce in the entity where it does bind. And so in effect, the non-bank subsidiary is an equity reservoir that sits directly adjacent to a capital constrained bank. For the bank to meet a tighter minimum requirement, it can either raise external equity at a convex cost or it can transfer the equity internally at a small per dollar transaction cost. When internal transfer is cheaper than external issuance, the firm's optimal response is fully internal. So as a bank's capital constraints tighten, bank equity rises 1-for-1, while non-bank equity falls by the same amount, leaving consolidated equity unchanged. We refer to this as the waterbed effect. Pressure on one part of the organization displaces capital to the other with no effect on the total. And this also allows us to generate a testable prediction in which we can distinguish internal reallocation from external issuance. Internal allocation should increase bank capital without having any effect at the consolidated level. External issuance should raise at both levels. Now, if the analysis ended there, reallocation would appear benign. The banks end up better capitalized and the firms have avoided issuance costs. But the concern is what reallocation leaves behind. Now the non-bank is thinly capitalized, and the same organizational links that allow equity to flow from the non-bank to the banks also allows losses to transmit back to the banks. We summarize this through a single parameter, which is lambda. So when lambda is equal to 0, it corresponds to perfect ring fencing, and when lambda is 1, it indicates full transmission. So the implication is a standard externality. There's some threshold lambda star below which reallocation is socially and privately aligned, and above which it generates unpriced systemic costs because firms bear the private costs of failure, but not the systemic component. So next, let me turn to the data and discuss the role of non-banks in bank holding companies. The left panel shows that non-bank subsidiaries account for 20 to 30% of holding company assets. The right panel shows that not only is non-bank activity large relative to the holding company as a whole, but it's also large relative to the non-bank sector. Roughly $1 in $4 of aggregate non-bank assets, roughly $1 in $4 of non-banks that sit in holding companies, non-banks and holding companies account for roughly $1 in $4 of aggregate US non-bank assets. So much of what's been described as shadow banking sits within the perimeter of the firm. And within the perimeter of the firm, the relevant internal margin is equity. If we decompose a parent's investments into bank subsidiaries, we find that equity dominates. Equity investments from parents account for 10% of bank assets, while non-equity investments is of the order of 1 to 2%. So internal capital markets and banking primarily operate through equity and not debt. Why is this? Well, there's a fundamental asymmetry within every bank holding company. While banks typically hold about 10% equity to assets ratio, non-banks often hold 70%. And you can see every non-bank type here reports an equity to assets ratio above 40%. So these non-banks are capital intensive. We summarize this asymmetry between bank capitalization and non-bank capitalization by introducing a concept we refer to as the equity multiplier. So the equity multiplier is a non-bank share of consolidated equity relative to the non-bank share of consolidated assets. We find that the median non-bank reports an equity multiplier of more than six, which means that it holds more than 6 times as much equity as its asset footprint would imply. Every non-bank type here reports an equity multiplier more than 1. Even non-bank lenders, which are the most levered category, report a multiplier that's almost 3 times their proportional share. So the consequence of this is that even small non-bank footprints can back a large pool of redeployable equity. And these subsidiaries essentially function as the firm's internal capital reserves. The size of the multiplier is what governs how much equity can be extracted when a bank's capital constraints tighten. And these conditions set up the pattern that motivates the rest of the empirical analysis. At the bank level, we find that excess capital between the two groups, holding companies with and without non-bank subsidiaries, moved in parallel until 2015. After Basel III was implemented, banks and holding companies with non-banks accumulate substantially more capital. The same comparison at the consolidated level doesn't yield any divergence. So together, these findings tell us that banks and organizations with non-banks accumulated more capital at the bank level, while there was no effect at the consolidated level, consistent with internal reallocation. So next, we turn to identification. The key endogeneity challenge here is that organizational complexity is endogenous and holding companies choose their non-bank footprint. This choice may be correlated with unobserved capital management strategies, which might confound our analysis. So our approach is to exploit variation in organizational complexity using the staggered timing of interstate banking deregulation from the late 1970s through the early 1990s. The idea is that states that deregulated earlier gave their holding companies more time to build more complex multi-subsidiary structures before Regal-Neal harmonized interstate rules in 1994. So to this end, we run a reduced form specification where years from deregulation is the number of years between which a state deregulated and national deregulation, and post is a post-2015 indicator. We include entity quarter year fixed effects and flexible control. So first, we show that there's substantial variation in deregulation timing across states. The lightly shaded states are those that had deregulated earlier. And again, these are states that gave holding companies more time to build complex multi-subsidiary structures. The validity test that matters most is the pre-trend analysis. Prior to the passage of Regal-Neal, we don't find any differential trends in the non-bank share between early and late deregulators. After Regal-Neal, early deregulators report a higher share of non-bank activity. And because organizational complexity is persistent, this source of historical variation can explain organizational complexity even 3 decades later. So next we turn to our main results. And what we do is we begin by taking our baseline figure and we feed it through this rigorous identification strategy to see if the results hold. Indeed, we find that banks and holding companies with greater non-bank presence accumulate more capital at the bank level, but there's no effect at the consolidated level. So the increase in bank capital and no change at the consolidated level is difficult to attribute to external issuance, which would likely raise both. And instead, it's consistent with internal reallocation. So mechanically, internal reallocation proceeds in 3 steps. The first is that the non-bank pays dividends to the parent, that's extraction. Second, the parent injects the equity into the bank subsidiary. And third is that the bank retains the earnings internally rather than distributing it upstream, allowing capital to accumulate. So first step appears in the parent's equity investments. We find that the bank's share of parent's equity investments rises by 2 percentage points per additional year of exposure after Basel III, while the non-bank share of the parent's equity investments falls by the same amount. And the aggregate amount of investment by the parent is the same. So this reallocation is symmetric, leaving the aggregate untouched. Where does the funding for this transfer come from? It appears in the dividend payout columns. Non-bank payouts to parents rises by almost 10 percentage points after Basel III, while there's no effect at the bank level. So parents are extracting equity from the non-banks and using it to finance the injection into the bank. The asymmetry between the bank and the non-bank columns is the mechanism itself. And we find that the response scales with the equity multiplier. So holding companies with larger equity multipliers reallocate more from non-banks to banks, and holding companies with smaller equity multipliers barely move. So the equity multiplier is a bit more than a descriptive statistic. It's essentially a constraint on how much reallocation is feasible. The third step is retention. Indeed, we find that banks in these organizations increase retained earnings after Basel III. And to close the loop, these firms with greater non-bank exposure reduce external issuance and increase buyback. So these firms aren't going to the market to raise equity. And indeed, internal reallocation and external issuance appear to be substitutes. So what's the problem? Reallocation makes the banks look safer, they're better capitalized, but the firm has avoided issuance costs. The concern is that now the non-bank is thinly capitalized, and the organization still remains exposed to non-banks through 2 channels. The first is contractual and non-discretionary. Parents and banks have intercompany loans and lines of credit with the non-bank. These claims lose value when the non-bank loses value. The second channel is discretionary. If the parent provides support to a distressed non-bank, it's drawing down on the same buffer that backstops the bank. And it can't credibly withhold that support because withdrawing implicit backing in a crisis can trigger the counterparty flight that it exists to prevent. So the question is therefore quantitative. How much of a firm's capital buffer is exposed if its non-banks incur losses comparable to 2008? So we apply shocks to non-bank assets and compute the equity injection that would be required to recapitalize the non-banks to a target capital ratio. So in the baseline, we apply a 5% shock to non-bank assets and assume that non-banks need at least 40% equity capital to function. So the left panel presents the parent equity at risk by shock severity. For the average bank, 18% of a parent's excess capital would be required to recapitalize the banks, to recapitalize the non-bank. But the average is not where systemic risk resides. The dashed red line traces the 95th percentile. And under the same baseline shock, 99% of a parent's excess capital would be required to recapitalize the banks, which is near total depletion. This relationship is also convex. With 10 and 15% shocks, the tail exceeds 100%, indicating parent insolvency. That's triggered not by losses at the bank, but by losses at the affiliate sitting beside it. The right panel presents the breadth. Under the same baseline shock, 4 to 6% of holding companies would completely exhaust their capital buffers. So this table summarizes the two halves of the paper, the bank capital gain and the exposure. Each cell corresponds to the share of bank capital gain that survives once contagion is netted out as a function of lambda. So when lambda is 0.5, we find that only 28% of the bank capital gain of the most exposed holding companies survives. The rest is exposed to non-bank losses. As we continue raising lambda, we see that the net effect is negative, and in fact, reallocation can actually leave the firm worse off overall. So next, we document the two sides of this divergence on the bank and the non-bank level, starting at the consolidated level. The consolidated results help explain why reallocation is undertaken. Consolidated profitability improves and charge-offs decline. Importantly, there's no change to portfolio composition or capital structure. So the improvement in profitability doesn't reflect the consolidated entity taking more risk. What it reflects is that the holding company is arbitraging the regulatory wedge across subsidiaries. And so reallocation appears to be privately optimal. Now, at the bank level, we find that consistently, the recapitalized banks are safer and more profitable. ROE and ROA go up and charge-offs fall. The question is, what are banks doing with the newly injected capital? And what we find are patterns of de-risking. Following Basel III, banks reduce their lending share while increasing their cash and security share. And the ordering of growth rates is informative here. Cash grows the fastest, followed by securities, followed by lending. So capital is deployed conservatively. New capital flows first to the safest assets. Importantly, this shift towards safe assets occurs without levering up. We find that assets and equity grow at exactly the same rate, so leverage is unchanged. Instead, the equity to risk-weighted assets ratio increases, consistent with being better capitalized, and the risk-weighted assets to asset ratio falls, which tells us that these banks are building larger, better quality buffers while simultaneously de-risking on the asset side of their balance sheet. So at the bank level, it appears that capital regulation works as intended. Banks de-risk by shifting towards safer, more liquid assets. The concern is whether there are externalities imposed on other parts of the organization. And the answer appears to be yes. We find that the balance sheets of non-banks sharply deteriorate after Basel III. As equity is extracted from the non-banks, the equity to assets ratio falls by 7.71%, while net balances to subsidiaries rises. So these non-banks are replacing withdrawn equity with intercompany borrowing. Dividend payouts rise consistent with the earlier results, but there's no change to total assets. So this is not a non-bank that's winding down its operations. This is a non-bank that's replacing internal debt for equity and operating with much higher leverage on a thinner equity cushion. The equity reservoir is essentially being depleted and the affiliate is being pushed on the parent's line of credit, which is what the stress test quantifies. Importantly, the timing is uniform across all outcomes. The extraction, the deterioration, the change in the business model for the non-bank occur simultaneously, and it's synchronized to the implementation of Basel III. So what do non-banks do now that they're operating with much higher leverage? We find that non-banks expand lending. Non-bank lending grows by 7 percentage points per additional year of exposure, while there's no change at the bank level. Credit provision migrates from the regulated, insured, supervised affiliate to the lightly regulated affiliate. This is the bank to non-bank credit migration that's been documented in earlier work, but here we show that it occurs within the boundaries of a single firm through internal reallocation rather than through competition. And the aggregate growth in lending is driven mainly by the consumer segment, where household credit risk is highest. So the consequences naturally follow. We find that non-bank credit quality deteriorates after Basel III and fragility rises. Serious delinquencies and loss provisions are up, ROE is down, the probability of experiencing negative earnings rises, and the distance to default proxied by the Z-score shrinks. These outcomes are the empirical inputs into the stress tests that we quantify. The thin, the concentrated, the more volatile non-banks are precisely the entities that are generating that tail risk exposure. And we find that parents are pricing in this risk. The internal funding rate that parents charge on non-banks rises by 0.5 percentage point per year, whereas the bank rates remain unchanged. For the median holding company, this corresponds to a 300 basis point spread. So the parent is pricing in this reallocation from the capital depleted non-bank affiliate. So to conclude, we make 3 points. Point number 1 is that subsidiary level regulation reallocates risk rather than eliminating it. Holding companies meet tighter bank requirements by extracting equity from the non-bank affiliates and then injecting it into the banks. Because they're not going to the market and this is entirely internal reallocation, there's no change at the consolidated level. So we provide some of the first evidence of equity cross-subsidization within financial conglomerates. Second, we show that the same shock can split the organization into 2. Banks appear to be safer. They operate with higher capital, lower risk-weighted assets, higher profitability. And non-banks appear riskier. They have thinner equity capital, more non-performing loans and loss provisions, and they shift towards risky lending. So risk is displaced within the organization rather than being eliminated. And third is that this represents a gap for consolidated oversight. Consolidated capital rules determine the quantity of capital, but not its location. These rules can be arbitraged within the boundaries of the firm through internal reallocation. And for the most exposed institutions, this contagion channel, the links between non-banks to banks, can erode the apparent improvement in bank capital if one looks at bank capital alone. So much of the bank to non-bank credit migration, in fact, happens inside the boundaries of the firm that supervision was built to oversee. The main point is that organizational structure can determine the regulatory outcomes. Thanks. Looking forward to Ileana's discussion.
Discussion to Julia Vega.
Thank you so much to the organizers for inviting to discuss this very interesting paper. I enjoyed reading it and I learned a lot. Genau. Baby is a boy. That does. All right. So no, let's see. So can this thing go away? Sorry. All right. So the setting is a multi-entity financial firm organization that where capital can flow across different entities. So I try to kind of visualize this with my nice stick figures here. So the BHC structure is composed of parent, bank subsidiaries, non-bank subsidiaries, and that's kind of the consolidated view. You can think of the bank subsidiary as the bank capital requirement, and there's a capital requirement on the BHC, on the bank holding company, but no, not on the non-bank. Now notice though that the non-bank typically is way better capitalized than the bank itself. So when you consolidate it, actually where the capital requirements are going to be likely more binding is at the bank level. So the question this paper is trying to ask is, how does organizational complexity, when you have a ton of those little things in the BHC structure, impacts the effects from Basel III tightening on internal capital allocation and systemic risk? And so they use, this doesn't often, they use, just with force. So they use cool data, both on the parent flows and then also non-public, non-bank financial data, so regulatory filings that make the internal capital market really visible. And they find that if you raise the capital requirement, you raise non-bank activity inside the BHC. Now there's 2 claims that they're making. I boiled it down to 2. So there's a within group equity shift. The parent moves equity from the better capitalized non-bank into the bank. And then the second claim is this is regulatory arbitrage, and we are actually increased systemic risk. The evidence for that is we need a non-bank capital buffer becomes thinner, while its lending, its risky lending in particular, grows, and the distress can flow back into the bank. Now, I think it's a very interesting paper on a really important question. So it's a little bit like on the first paper also. I think there's a lot of, this is where a lot of the rubber meets the road type of where regulation happens. So we have this multi-entity firm, it creates this internal dividend mechanism, and it's really hard to trace without this like nice data. There's some earlier evidence, but this paper goes beyond that. And it's really neat that increases in capital requirement actually can raise non-bank activity within the BHCs, not just outside, which what prior literature has found. So 2 comments, one on kind of like what's the causal interpretation of the fact that we are looking at, and does really this business risk reallocation that we observe is evidence, at least as to this moment, what we see in the paper, evidence of systemic risk or even risk at the BHC going up. So my reading is actually, I believe totally this equity shift inside the group is really compellingly documented. The question is whether it's more as a result of compliance rather than regulatory arbitrage. And so I will make that case, devil's advocate case, for it's just compliance. So in this orange box, you see that like post 2015, there's been a ton of rules happening at the same time, right? So the GSIP surcharges, stress test, these are all can vary at banks level. Advanced approach banks, they actually introduced Basel III a little bit earlier. There's tailoring, there's literally capital rules that depend on like how much the non-bank share varies in a bank. So you can be, if you have more non-banks, you get it put into a tighter bucket. Now also assume that this, which is kind of backed up by the data, that the non-banks started with a lot of excess capital. So maybe even from the post-crisis, they become more disciplined. The non-banks within the BHCs maybe have more excess capital. And now you shut down external market. Now, if there's one of these rules on the bank subsidiaries starting to tighten, well, the optimal response is exactly as their model would say, just route some of the excess capital from the non-banks to the banks. That doesn't have to be a sign of systemic risk or anything going on. So I would argue that like almost, I mean, like I try to model this, so that almost you can generate all the same flows that you paper documents just with a compliance mechanism, not arbitrage. So and to see why it's a little bit tricky to identify in the data. And it's really tricky. They tried really hard to do it right. So it's not the author's fault, but so there is a shock, Basel III. And you want to see how that Basel shock kind of interacts with complexity. Well, complexity is obviously endogenous. So you might try to shock that why are some banks more complex than others with the time the BHC's headquarter state had until Riegel-Neal. So when it was deregulated from its branching restrictions to Riegel-Neal, which was in the middle of the 90s. And so some states deregulated way earlier, and that allowed these banks to become more complex. Well, and some others happened to open a BHC in a late regulated state. And so then that also exposes you already to different rules, Section 20 that happens in the mid-90s that allows you to kind of grow certain revenues, non-bank revenues, more than others. Anyway, so you have this complexity channel that they're interested in, whereby these complex firms have the ability when the shock hits, the capital requirement shock hits, to extract more capital outside of the bank, and that moves the outcome. But then in addition, the complexity itself interacts with some of the shocks because the rules itself are sometimes functions of the complexity. So then you get a whole different kind of confound, who is affected by the rule and who's not. Some of these banks might be more profitable to have a non-bank business, so you can also retain more capital, that they can grow richer. That allows you again to build up more reservoir buffer, again, being able to affect these outcomes. And then obviously size and complexity are somewhat intertwined. You get a whole host of that. And as you said, like, I mean, well, there's like you can try to control for it, but these regulatory thresholds, when supervision comes in, they're also non-linear, right? So, and then this is a little bit tricky. So point is this Z, the instrument that we are trying to have here, bundles complexity with size, with non-bank equity, and the complexity itself. And that makes it really hard to get basically at the capital extraction channel that the paper's interested in. And just so I collected some data on who are the CCAR, like the stress test banks, and like looked what the BHCs, where the state of the BHCs were and whether they were in the early deregulated state or not. And you can see there's the GSIPs and there's the stress tested bank, that a lot of them, 88, 90% of those banks were in early deregulated state. And then obviously, I mean, that's kind of consistent with the first stage of the paper, but a problem for the exclusion restriction given because these other banks are also exposed to a host of different regulation. And again, the regimes are themselves, the regulatory regimes are buckets that are non-linear, dependent on complexity too. And so that makes it hard to purge with linear controls, which the authors really try to do. So just what what I've tried to do is a little bit put their model. They had a little tiny model that they also simulated with the BHC, has two subs, bank and non-bank. It has some revenue. Then you can expose the bank to the capital requirement. The non-bank does not have one. Internal equity transfers are cheaper. Increase the capital requirement. The parent extracts equity from the non-bank to the bank. Now you can simulate the model extensions where you make these banks heterogeneous. They're differently productive. That increases their size and maybe complexity. And then you draw also in which state they kind of start to be founded. And if you're in an early state, you will be growing more complex as compared to a late deregulating state. Now, then motivated by this post-2015 rules on complexity and that are size dependent, I put some here. That means that there's variation across banks into what target they have. And that interacts with the rules. So you can make the capital requirement a function of the size and the complexity itself. That then you can basically run the simulation, generate basically the rerouting mechanism. And once the capital requirement is increased on some of these banks, and it will be differentially increased, you can recover basically a parameter on that simulated data that's in line of the data. So the data is like it's the first is a little bit imprecisely estimated is the black thing there, and then my bank cluster to estimate on my simulated data is in blue. You can do state clusters, given that this actually state level instrument, that will be better. Anyways, so then it's also hard to control for that. So they put in controls for complexity. And then if you had perfect, oh, that's a typo, but a linear control, complexity control, if you had a perfect one, so you would actually could almost, if it's linear but perfect, not, so it's actually non-linear, but if it was a good measure of complexity but linear, you still can have a positive coefficient, but it becomes insignificant. The problem is really you get the complexity rules that themselves, the truth is zero, right? The complexity rules themselves are non-linear, and in the practice, they're going to be difficult to estimate. Now, you can also not really control it from the premise of the paper, because that's kind of what they are trying to find the modulating effect for. So that's why this is a little bit hard to do. Okay, that's for the authors. So and I have 5 minutes for my second point. Is it systemic risk from regulatory driven equity reallocation? So they list a bunch of observed things. Parent equity reallocation, non-bank equity goes down, non-bank past use increases, the distance to default declines with this partly mechanical. Once you know equity goes down, distance to default goes down, then Merton's PD is also a function of distance to default, is going to go up. So intercompany exposures, parent injection after non-bank losses. So all that's okay, right? And then we assume or calibrate shock sizes, assume full parental support in the stress test, the transmission, which is basically the externality that is imposed here, and the failure cost. What we have not really shown outside of the simulated evidence that actually bank holding company risk has gone up in the aggregate, or that there is any systemic risk consequence. And here we could push a little bit more. And I want to, this is too much, I continued simulate, I love simulating data. So I simulated more my models and what I found, but is this, you have to think of it as another regulation that I also figured out later, right? So there's regulation W that constrains some of the banks to affiliated support channels. So there are some rules that kind of tie them. The point is that some of the things that are captured by your lambda are also regulatorily bound, and going a little bit deeper on what this what the friction externalities should be to actually create that the BHC risk goes up and can cause systemic risk to rise. That has to be more sharp. Okay, because I can come up with a simulation where nothing happens, is my green thing. Yeah, nothing happens, or BHC risk goes false, right? Because if we're just shuffling around equity within the BHC, who cares? Yeah, you need this lambda, you need to kind of somewhat an externality that we are getting extra losses from having the loss now in the non-bank. And that hasn't been established. You just see that there's shifts. Yeah, we see that there's been a shift. Observed banks are safer, non-banks riskier, BHC risk increases. Again, doesn't mean that it does have to happen. The bank de-risk, again, is consistent with the compliance story. The bank de-risk because it has to comply. It needs to can comply by increasing equity or reducing risk-weighted asset. Can reduce risk-weighted asset of getting rid of risky consumer loans. It does that, perfect. Then what can also happen, and I would say that this graph here is a little bit as consistent with that, the demand for non-bank credit externally has also been rising around this time, and people have documented this, can be coming from technology itself. It can come also again from a host of additional regulation, consumer rules that kind of make it less attractive for banks to issue mortgages, etc., or invest in mortgages, etc. And so that is also consistent that we see the non-bank loan share, which you see the graph on the paper on the right, per extra year of deregulatory exposure. Again, that just means we're comparing more complex banks to less complex banks, is consistent with more complex banks, meaning maybe no more non-bank business banks, progressively housing more lending in non-banks. They might be just better able to capture the rise in non-bank lending demand. Like, I mean, may or may not happen. So again, you can also study the standalone lenders that earlier Richard has done to see whether that kind of if these trends are kind of tied up with that or not. So in my last 1 minute, I have a few suggestions on how to tell this apart. I mean, you can think if there's, so is it arbitrage or compliance? So do in 2024, non-bank equity ratios end up below the pre-crisis levels compared to standalone broker finance companies, or revert toward them? So again, this is a question, what's the optimal capital ratio of non-banks? You haven't, just by going down, it doesn't mean that they become riskier if they're way above the buffer. That makes them actually really risky. So if they have an order of magnitude, they're an order of magnitude better capitalized than banks. So it's not clear. So where we can look at this, we can also sort equity flows by the 2013 distance to the requirement at the bank level, arbitrage, or just you have the data, go really deep into per bank category and see how are the rules actually binding. The timing, I think a lot of the flows also on the graphs seem to line up also with stress test cycles and the phase-in of all these other flows, or is it more really like your Basel III? Anyway, and then you can also go in the full model version, which I would obviously prefer. So you can kind of quantify these different mechanisms. And so I'm out of time. It's a very interesting paper on a first order question. To me, really the equity shift inside the group convincingly documented. Its causal attribution and systemic risk consequences less. And I think there's a bunch of open questions. I'm very excited, and the authors are well equipped to answer them. Thank you.
Briefly reply and then take questions.
Sure. Thank you, Juliana, for the discussion. I think it's super helpful to get a fresh perspective on what we're working on, and all the points are very well taken. I'll just comment on one part very quickly, which is on whether there's actually evidence of empirical contagion. Of course, in the post-crisis, we haven't experienced a shock as large as 2008. So that tail risk that we try to get at doesn't appear empirically, but I can provide some anecdotes and some additional tests we did in the appendix that might add some color. So, you know, in 2007, 2008, Citigroup absorbed $49 billion of structured investment vehicles back on their consolidated balance sheet, which depleted parent capital and also contributed to their reliance on TARP. Similarly, Bear Stearns had extended a $1.6 billion loan to a hedge fund that was in distress, which also led to parent funding pressure, and eventually the firm had collapsed in 2008. There's similar examples with HSBC. One thing I'll point out is that credit rating agencies directly they assume that the parent is going to provide some kind of support when an affiliate experiences distress. So for example, JP Morgan's broker dealer has a credit rating that's 2 notches above what the bank holding company does. For Goldman Sachs, the difference is even larger. So it suggests that at least markets are somewhat pricing in the fact that the parents might intervene when crisis occurs. What we do show in Appendix D, which is lost in the back, is that when we isolate periods like COVID in 2023, we do see that bank holding company bond spreads widen which is suggestive that the holding company is affected in periods where the non-bank affiliate experiences distress. We also find that when the non-bank affiliate experiences distress, the bank affiliate contracts lending, and the parent increases support to the non-bank, increases equity investment, and decreases it to the bank. So that's just some anecdotal evidence, but I take your points, and there's certainly more that we can do to show systemic risk goes up in the aggregate. Yes. Bill, and then, yeah.
Are we supposed to go?
Yeah.
So I totally buy your economic story in your paper, but I was puzzled by your identification because you're using the years since deregulation, and the deregulation that you're looking at has to do with bank branching and ownership by bank holding companies of other banks. It doesn't pertain to their investment in non-banks. And yet, there's other kinds of regulations happening around the same time that did pertain to bank holding companies' ability to invest in non-banks. For example, Julianne mentioned the Section 20 affiliates. The Fed started allowing more and more of that kind of investment. There's heterogeneity in the implementation of that deregulation across bank holding companies. So to me, that's the natural source of variation to use in your setting, not the deregulation of branching or interstate banking.
I take your point. The idea is basically that through acquisitions after deregulation of banks, some states allowed banks to have non-bank activities such as insurance affiliates, and through the acquisition of banks, they may have increased non-bank size. That's the idea behind it, and we can certainly explore other regulations. Yeah.
Why don't you take a couple of questions?
Sure. Yao, Naz, Stephen.
That was super interesting. I wonder if you could zoom in, given the super rich data you have about different types of non-banks. Because I mean, as I think about that, if you extract $1 of equity from your insurance company, that could be quite different from extracting $1 from your mutual funds or money market mutual funds or a direct lender, because they carry totally different systemic risks. So I wonder if you could talk about that. I mean, by looking at the heterogeneity or breakdown, instead of just bundling everything within the same bucket of non-banks. And I think broadly, there could be very interesting portfolio choice problem, given that like imagine you're a parent, right? You have different kids and they do different things. And you are subject to this requirement and what's the optimal portfolio. This is not about asset type. So a very interesting portfolio choice on the equity side.
It's quite interesting that the non-banks hold so much equity despite not being subject to any kind of capital regulation. It suggests that they really need it to do their business. I wonder whether you could look at whether different types of non-banks require amounts of equity, kind of following on Yao, and maybe they're just shifting into activities that require less equity rather than necessarily shifting to riskier. Because maybe the consumer lending just is less capital intensive.
Stephen?
Oh, yeah. Can you make sure the mic is?
It is.
It is?
Yeah. Looks sure. We can
Yeah.
do it.
Okay, anyway, I was a little confused about the profitability numbers because you're showing that the banks exhibit increasing profitability in the increasing profitability in the non-banks have decreasing profit. So is this just a question of the transfer pricing within the holding company? Because I would think if you're transferring these riskier assets to the non-banks and they're priced properly, and there haven't been crises, then you should see the non-banks with higher profitability. So what's going on there?
You want to keep going?
I can take one more. It doesn't seem like there are other hands.
I'm trying to figure out whether I should take a lesson away from this for regulators and supervisors. And my understanding is that stress tests and actually supervision is done at the consolidated level of the bank holding company. And so part of this is that this shifting around, that if you're doing a stress test properly, that doesn't matter, right? Because it's whether or not the whole thing runs out of capital, the entire enterprise. So I'm trying to figure out whether this is creating some kind of fragility in the organization that isn't being captured by existing supervisory practice?
Okay, let me start with the last question. So the consolidated requirement constrains the total amount of capital, but it doesn't constrain its location. And the bank level requirement is what's kind of there to constrain its location. So the non-bank assets really enter in the consolidated requirement. And the consequence of this is that a non-bank can become arbitrarily thin without tripping any kind of requirements as long as the consolidated ratios hold. Now, from the supervisory's perspective, supervisors are looking at the consolidated ratio, but what the issue is, it's perfectly legal for a bank to extract equity from a non-bank and inject it to a bank. It may only draw alarm when there's like a systemic pattern. And so so I'll stay away from talking about the policy implications, but the general principle should be that supervision ought to treat the location of capital within its perimeter, not just the consolidated quantity. Okay, so and then the other question about different types of non-banks that Yao had, how is it different for insurance and mutual funds? I think that's a great point. We haven't totally explored the heterogeneity in the types of non-banks that are held in holding companies. Our summary statistic, which is the equity multiplier, is what we've kind of been using to try and make the point that to support the mechanism that more extraction occurs if your bank holding company has a larger equity multiplier, less happens if you have a smaller one. But we can certainly do more to study the financial stability implications. On Naz's point, we do see that there is churn, compositional churn in the holding companies. We see that a lot of holding companies that didn't have a non-bank affiliate are more likely to add a non-bank affiliate. And after 2015, they're also more likely to exit certain activities like trading or VC, or if they have an insurance business, which tends to be more equity intensive. From looking at the balance sheet outcomes, it does appear that measures of fragility rise. We do find that ROE declines, the distance to default shrinks, probability of default is higher. So it does appear that the non-bank becomes riskier. The question about transfer pricing, I have to think a bit more about. What we do find is the parent is certainly charging the non-bank subsidiary more whenever the non-bank is borrowing from the parent. And our idea that the non-bank becomes, or the rationale that we have behind why the non-bank becomes riskier is that they perhaps have less expertise in certain segments of lending. And that's why we see a decline. But I'm open to other hypotheses that we could test in the data. Yeah, thank you.
Yeah. 2 minutes if there's any other questions.
Larry.
Right.
We have an error.
Yeah.
So I was still curious about the kind of a second question. It's just, it does seem like you are meaningfully changing the default option of who's on the hook when bad things happen to the bank. In the event that these transfers don't happen, right? So sponsor support isn't required necessarily. Like sometimes you made some points about contracts, which sort of would mean that there has to be a transfer from one group to another. But in principle, you could think this is still helpful in that the set of creditors or kind of other liabilities of these different subsidiaries who are affected might be different. The externalities imposed on those people if something bad were to happen to one of the subsidiaries are different. And so this could still be like a welfare improving activity, I would think.
I agree.
So yeah. Just kind of, because sponsor support, it's like it's a real option. I don't have to exercise it. I can choose to exercise it typically if I think it's worthwhile to keep that business going.
That's right. Yeah. So in the toy model that we have, we show that there are these opposing forces, which is that when you have this non-bank support, the bank is less likely to fail. And so there is a benefit of protection, but there's also this new contagion channel that if you're exposed, there might be a channel through which losses transmit back to the banks. But it does appear from the calibrations we do that the protection channel dominates. And indeed, banks, it's good for banks to have, on average, it's good for banks to have access to this non-bank, and they are willing to let the non-bank fail if they can survive. Thank you.
Thanks very much.
Thank you for including our paper in the program. So this joint work with Matteo Jacobiello and Danilo. We're both at the Federal Reserve, so the usual disclaimer applies. These are our views and not of anyone related to the Federal Reserve System. So the idea of this paper is that, well, regulation and deregulation are front and center in the economic policy debates, but like measuring the direction and the intensity of regulatory changes is quite hard. There are some approaches, they face trade-offs. For example, the OECD has some cross-country indexes. They are quite infrequent, not suitable for time series. The Federal Register actually has like every single rule, like published, especially since 1995 on a daily basis, but it does treat all rules equally. You cannot distinguish like direction. One could use keyword-based news indexes, but it's quite hard to actually separate what's like the regulation from regulation, that part. And there are some firm level measures, including from Joseph Kalmenovich, who is going to discuss our paper, and Kalomiris, Mamaisky, and Young, which are closest to our approach. They're quite granular on the firm level exposure, but they're not like focused on economy-wide effects. So what are we doing in our paper? We're going to use large language models to construct a comprehensive, high-frequency deregulation index for the US since 1960 and study its economic effects. And if you find all the rest of the paper quite boring, this is the paper in one picture. We have a news-based deregulation index that captures every major deregulation wave in the US, and we can talk a little bit about the shift of scope over time. We compare against Federal Register documents. We find that this news measure leads formal implementation by about 1 year. We have an empirical macroeconomic model where we find the effects of higher deregulation that end up like inducing higher GDP, investment, productivity, and stock prices. Then we go to a panel regression of industry returns on industry-specific deregulation. We find some positive effects on industry returns. And we look at firm level deregulation exposure from earnings calls. And we do find that firms increase investment in response to self-reported deregulatory exposure. Okay. So moving to the index, so what we do, our sources, we have all news articles published in the New York Times since 1960. We do a two-stage approach. We first pre-filter what are the articles that are actually talking about regulation in a very broad sense. That gives us about 600,000 articles out of 2.5 million. And then we go and run each one of those articles through ChatGPT with a prompt that instructs how to quantify the regulation in each one of those articles, okay? This prompt is gonna assign intensity scores from 0 to 1. You can think at 0, no deregulation is being discussed, like low levels of like something very limited or of a small scope or more regional, all the way to full-blown implementations of deregulation in a broad sense that would get a 1. It can distinguish between deregulation and regulation, advocacy, proposed and enacted, and it can capture this extensive and intensive margin of deregulation. Extensive in the sense that we can count like how many articles are actually talking about deregulation and the intensity if these are economic relevant the regulatory mentions or not. Our daily index is going to be the sum of all these AI scores across the sampled articles divided by the total number of New York Times articles on that day. And the key definition for us, deregulation, is reduction, elimination, or simplification of government regulations. Here, you probably cannot read, but it's just to give an example. This is our full prompt. We have it in the paper as well. But the idea is that we define what deregulation is. We give an instruction that we want an economic focus that separates between deregulation and more regulation. We define what is not deregulation. So for example, tax cuts or fiscal policy is not deregulation from our interpretation. We have like a specific on trade liberalization. We have 2 indexes between US and foreign, and then we score a scale in the sense that I explained to you before, from 0 all the way to 1 with like major deregulatory in a broad sense. And then we have critical rules. For example, that pro-regulation articles obviously get a 0, and articles about past deregulation, they are not counted as current deregulation, okay? Just to give an example of how these articles look like. So this is an article that gets a score of 1. It's an article from 1978. The primary focus is deregulation. So you have like here an excerpt that says, provide airlines the broadest freedom in 40 years to compete for passengers by lowering fares. It's quite broad scope, affects an entire sector. It's not just like a historical retrospective mentioning. So this is a type of article that pushes our index during this deregulation waves. So what are articles that do not contribute to our index? For example, this ballet, some 19th century tradition by workshop. So Alexandra Danilova staged the second act of Swan Lake along more or less regulation lines. If I were to search less regulation, I would get this article. It would count for me. The AI knows that it's not about the regulation. It puts a 0. We had to study what is a less regulation in ballet. That means it's adherence to original choreography. Finally, how do we actually validate our measure? We compare with human evaluation. We do a sample of 500 articles among 7 research assistants with the same, we tell them to use the same scale and definitions that we use on the AI. And what we find is that the correlation of our index and the correlation with the humans are similar to the interhuman correlation. So not everybody agrees. The disagreement is kind of similar to the disagreement that we get from the AI and the model. We test several models, smarter models. They all give kind of like the same correlation. We stick to the one that is faster and cheaper. And this is how it looks like. So this is a measure of deregulation for the US since 1960, okay? Most important thing from this figure is that deregulation comes at waves, okay? So you get the Carter deregulation like in the 70s, the Reagan presidency with spikes like in the 80s, the whole like deregulation during the Clinton presidency with like telecom, banking reform, the Glass-Steagall repeal Telecom Act, and then the 2 Trump presidencies, okay? Cool. As I mentioned, we're focusing on deregulation. One can just take our prompt and flip it to more regulation, right? So it's very directional towards deregulation. So what we do, let's rewrite our prompt, just what would a measure of like more regulation would tell us. And then one thing you can see here is that, so the regulation index is in red, deregulation is in blue. Deregulation really comes in waves, while more regulation increases over time, and it's much more stable than actually just deregulation waves, okay? Great. We have a bunch of articles talking about deregulation. They have much more information than just telling if this deregulation or not, which are second steps that we can ask the AI. So for example, one of those is that, okay, this deregulation, which sectors are actually being affected by that deregulation? So what you're seeing here is a heat map compared over its own time series. The sector that we have more deregulation articles is finance, for example, and then you can see like the moments where those deregulations happen. I'm not going to spend much time here, but they do match historical identified deregulation episodes in the US that we have discussed in the paper. This is just like the time series of deregulation, regulation for some of those sectors. I'll focus here, for example, on the financial. You see all that the solid blue line is deregulation, while like the gray light is more regulation. You see all this deregulation happening all the way to almost like 2000, and then we have like the global financial crisis, and then increased regulation right after. Okay, and then also like, for example, that we've been of discussion around like housing. Then you see that housing, you have like a quite spiked here recently as well. Another cuts that we can do. Okay, this there's a lot, again, there's a lot of information on this article. So we want to check like what type of deregulation is being done there. So we try to measure if the article is talking about increased profits, competition, or decreased prices. So first we see that like during the 70s and 80s, something that's already like quite evidence from the literature, that it was more like competition-driven deregulation that was translated into gains into consumers. So we see this like increased competition, like most of the articles are talking about increased competition, while since the 80s, we see the share of profits quite rising from 30 to 40%. So essentially we see like this transition between more like entry barrier removal towards compliance cost reduction over time. Okay. Great. So this is news articles. How do we know that it's not just like fluff, people talking about deregulation, things that don't really happen? So forget about the news for now. Let's look at actions or like deregulation that was actually put in place. So what we do, we go to the Federal Register. We downloaded 120,000 Federal Register documents, which are rules and executive orders since 1995 is what we have like available. And then we go and do the same thing that we did before. Let's ask AI to go look at each one of those rules and tell me if it's the regulation or not and how important it is. Because one important aspect here in the US is that for you to deregulate, you need a rule. So just counting the number of rules doesn't tell you anything about the regulation or more regulation, okay? And this, for me, is the coolest figure in the paper. In blue, you're seeing our news index from the New York Times. In red is the one that is actually coming from the Federal Register. So effective deregulatory measures in the Federal Register. And they basically move in tandem. You can see like that they have a correlation of about 0.8 into a space of about 1 year. So the news measure, like the talks over the New York Times on deregulation, really leads actual implementation of deregulation that is showing at the Federal Register. Okay. Now, what do we do with that? We know that the regulation comes in waves. We don't know what are the economic effects. Let's try to measure that. What we do is do an empirical VAR model with usual real economic variables and some financial variables, traditionally the literature. We have our regulation index, our deregulation index, and we're gonna do a shock into these deregulation waves to see what are the economic effects coming out of it, okay? And this is how it looks like. So the shock is here on our deregulation measure, okay? So productivity doesn't really change when the shock hits, but it increases in the long run. But GDP and mostly investment do react a lot in anticipation to this deregulation. So despite resemble a usual technological news shock, I know that I'm going to be more productive in the future. The firms know about that, they go and invest based on this expectation, and this end up pushing GDP. When you look at the other variables, we find it mildly deflationary. So there's kind of like a supply side component on this shock. Nothing much happening on government expenditure, so we're not really capturing a fiscal policy shock here. Corporate profits tax rate is also not changing, so we're not really capturing any, I don't know, like reduction of tax rate that sometimes comes in tandem with deregulation. We see the VIX decreasing, so there's some sort of like reduction of uncertainty on impact, even though it increases a bit in the medium run, and stock prices react quite strongly. Okay. So how do we validate these economic effects? We have a bunch of sectors identified also like by AI. So we have sectoral deregulation measures. We can go and match them, for example, with like industry portfolio returns. So we take the 49 industry portfolios from the Fama French, we match with our sectoral deregulation, and then we want to see if there's some information on the cross-section there that could also explain these stock returns. So what we do some local projections of this stock returns into the sectoral deregulation. And when we look at that, we see, so this is cumulative returns. You see that stock returns respond quite strongly on impact when the deregulation shock happens, a little bit more in the second month, and then it stays on that new higher level. Okay. Great. So far I've been telling you a story that there's a bunch of talk about deregulation. This anticipates actual changes in the Federal Register or like actual deregulations being implemented. And then firms know that they will deregulate, like that there will be deregulation in the future. This will affect them and they go and anticipate by investing more. If this is true, if I go to earnings calls, they should be talking about deregulation. They should be talking about increasing investment in response to those expected deregulation, okay? So what we do, we consult a third measure of AI. We download 220,000 earnings calls of public listed firms since 2006 is what we have available. And then we also do a two-step approach. We first extract the deregulation related mentions, and then we go and run an AI on each one of those like earnings calls to try to identify first, when they talk about deregulation, the stage, if it's just actual deregulation or expected deregulation, what is the exposure, like in a 0 to 1 scale, on how much the firms are affected by deregulation, and the investment intentions, if they stated plans to increase or decrease capex or R&D. Okay, and the index is going to be the sum of the exposure by period, normalized by the total number of firms. Just an example of an earnings calls that would drive our index. So this one, for example, Ameristar Casinos in 2009, there have been a huge synergies between the Black Hawk regulatory reform and the opening of our hotel. Just from the regulatory reform alone, our net revenues are up by about 24%. So when we run this through the LLM, it's going to give us a deregulation exposure of 0.8. The stage is actual, so it's actual deregulation. The attitude is positive, and the investment intentions is an increase. And this is how the measure looks like. Of course, a much shorter sample, but the spikes do match the ones that we observed both in the news-based measure and on the Federal Register index. And one interesting thing is that there's a lot of discussion on those earnings calls that's about expected deregulation, not just about actual deregulation measures. The last validation that we do empirically, we have this on the firm level. We can go and match that with Compustat data on firm level investment. And then what we see is that if we run a local projection of this firm level investment on this firm level deregulation sentiment, we find that investment increases around 8 to 12 quarters after the deregulation discussion happens. Okay. And this is also like a robust show of different controls and lags, and fixed effects. So just to conclude, we have a novel measure. We have like daily deregulation index that captures the intensity, direction, and policy stage of deregulation. We can decompose by sector type, geography, and we do find that this news-based measure, it does lead the Federal Register implementation by about 1 year. We document the evolution of US deregulation that moves more like from this price controls towards like product and service standards. We find the macroeconomic effects after these deregulation waves, they induce GDP, investment, productivity, and stock prices, and also corporate profits, quite resemble with like technological news shocks. Again, these are average effects, they are positive. These are not necessarily that deregulation is unconditionally welfare improving. But we do find some distribution implications that the recent deregulation is increasingly associated with higher profits in comparison to competition, which may favor incumbents over new entrants. Lastly, we have all this data available it's in Mateo's website on a daily basis, all the sectors, all the cuts, everything is there, then you can play around, and if you find something cool or interesting, just let us know. Thank you.
Thank you. And the discussion is Joseph Pomerantz.
Use these arrows. Oh, okay, thanks. Have 15 minutes, right? Okay, I'll try to stick to it. So thank you very much for inviting me and giving me a reason to read this paper again and a little bit more deeply. So let me summarize this in one slide, and admittedly, this is not as good as your one-slide summary, so apologies for that. The goal of this paper is to measure US deregulation in the US at a daily frequency going all the way back to 1960. And the second goal is to try to understand what is the economic impact of deregulation. Now, what is the measure about? What the author do, they use GPT, a version of a 4.0 mini. They take all the New York Times article from that period, and then they apply this classification method. And essentially, they score each article on a 0 to 1 score. They aggregate it up. That's going to give them the daily index. And then there's also a very nice and interesting disaggregation or decomposition by sectors and later on also by firms. And the second part of the paper is trying to, take this new index or this measure and try to understand, what is the effect, what is the result of deregulation? And as I guess most of the people in this room would have thought originally is that when there is more deregulation, or in other words, when there is less regulation in the economy, we're going to see an increase in GDP, in investment, productivity, everything looks great, stock returns, and so on. These are all the results of deregulation. Now, first of all, I have to say I like the paper a lot. There's a lot to like about the paper. A lot of effort went into this. It's a daily index. It's a very, very long run. It's publicly available. The website is great. If you haven't visited already, I strongly recommend. It's very easy to use. It's very fun to kind of experiment with these data sets. It's a very creative use of both LLM and AI. We live in a very interesting times where all of us can just, take off-the-shelf tools and do things that even 2 years ago, nobody ever thought that we would be able to do. So this is a very, very cool. And finally, it's both aggregated and disaggregated, so anybody, can pick and choose whatever works for your line of research. This is all great. What I'm going to do today with the remaining time, I want to give a couple of comments or suggestion more on the concept of what is really that we're trying to measure, what we can really do with this. I'm going to start by asking what exactly are we able to capture with this data set that we have in the classification. And what I really think is going on, we're capturing primarily discussion about deregulation rather than deregulation itself. And this has downstream effects on the next two comments I'm going to spend less time on. Is the first one is what is the source that we should use? Is this primary source or secondary source? And the last one is about the economics of this is really what the measure capture. What are we supposed to learn from it? Now, I do want to say the version that I received did not have the last 3 or 4 slides with the firm level, but as I was listening to a presentation, I have some thoughts that I'm happy to share on how it relates to existing papers that are close to me. Okay, so let's talk about the deregulation score. So let's just remind you of figure 1 in the paper, which is the prompt that is used. So what we do here, we take a sample or a large sample of a New York Times articles, and then we're going to send it to the AI, train it properly and so on, and we're going to get a score of 0 to 1. Now, if you look closely at the prompt, what it really does, it primarily gives the highest score to articles that discuss regulation or deregulation more intensively. So essentially, it's going to increase if it's only 1 or 2 sentences or if it's complete misclassification. It's going to get a 0 score. If it really, really talks about deregulation, you're going to get a score of 1. Why is that important? What it tells me, at least the way I understood it, is that all of this scoring process and the resulting index is about how intensely the New York Times or whatever journal you're eventually going to use, how intensely is the discussion about deregulation. That's the direct measure. Now, what it does not directly measure is, first of all, whether there is even deregulation. For example, it could be just discussion about proposal or something like that. And it certainly doesn't really capture directly the intensity of that deregulation. Now, instead of just theorizing, I try to play it a little bit with the prompt myself. So I give a couple of examples to my trusted friends at Gemini and ChatGPT and Claude and all of them. And these are a couple of examples that I think illustrates the gap. So for instance, if you're going to have an op-ed by a bunch of CEOs that really urge the president or wherever it is to cut the rate caps. Now, I believe the score is going to be pretty high, probably 0.6, because it's a very, it's a big focus. It's an advocacy. Is there any deregulation? Nothing. It's just advocacy. Now, what about a deregulation bill that has heavy coverage, but eventually was voted down? It's going to be a major focus of the article, but there is no deregulation. The bill has actually failed. Or another example, what happens if there is transfer? One agency is going to relax the rule, the other one is actually going to take over. There is 0 net effect, probably or close to 0. It's going to be a very high score on the deregulation index. Another example, Coast Guard, they do a lot of regulation that maybe people in this room are less interested in, but what happens if they relax one of the most burdensome rules on the fishery industry? Now, this is deregulation, right? That's a real cut. Maybe we don't really care about this, but I'm sure the fishermen do. It's probably not going to get any score because the New York Times doesn't care. Yeah. Now, all of this is not to say that the index is wrong or false. It just tells you what the index, I believe, is actually able to capture, and that is the discussion of deregulation in the New York Times during that time, which is a different object from the actual deregulatory policy. Now, why does that diverge? Why are those two things different? The primary difference is, of course, that you have the underlying object, which is deregulation or regulatory policy, and then you have the reporting choices of the New York Times, whether they choose to talk about, how are they going to discuss it, and these two things, the reporting choices and the underlying object, could diverge significantly. One of the examples I was thinking about is, this literature is very much interested in the difference between stock and flow. So the New York Times presumably is not going to talk a lot about the stock of existing regulation. They're going to cover flows, with rule proposals that come in, rule proposals that fail or succeed, which is interesting, but is not the same as the actual stock of what's happening in the economy. And another thing is, oversimplification, partisan bias, all of these issues. You might kind of simplify things and then don't really capture what is really happening, who is bearing the burden, and who is really deregulated. What I want to do in the remaining of the time is try to take this distinction, try to think a little bit more about the potential contribution, positioning relative to other papers, and finally, if I have a couple of minutes, talk about the economic impact. If this is what we measure, what are we gonna do? There's a lot of paper in the last 5 or even 10 years that try to quantify regulation, and most of these papers, except for a couple I'm going to mention in the next slide, use primary sources. What is a primary source? I'm going to start with what's called in this literature supply, which is the government is writing about regulation. It's going to be the Federal Register, the Unified Agenda, whatever it is. And thankfully, you can say a lot of things about the federal government, but one good thing is that they talk a lot. Okay, they talk a lot about the intention. You just need to read it, and nowadays everything is available online, digitized. It's very easy to work with this data set. These are the regulatory texts that we use to understand, to quantify regulation. And then there's also the demand in quotation mark. These are firm disclosure, like earning calls, 10K, 10Q, 8K, whatever it is, where firms talk about regulation, talk about deregulation. You take either or, you combine the two. That's what papers in this literature usually do. I put here a list of just some papers that I'm familiar with. I'm not going to read all of them now. I do want to give shout out to the Reg Data. This is the first one that you see here. I think they were the first one that did this on a really large scale. They provide a public good. Everybody could download those data sets. They map them to industries. It's a very interesting data. And of course, I have to mention my own paper that is about regulatory intensity. But like I said, there's a lot of other papers. All of these measures are available at very different frequencies, granularity, aggregate, industry, firm level. You can work with all of these. Now, there are a few papers that do use secondary sources. These are papers that look at media coverage of regulation. And the two that I believe are the closest are the EPU index. That was Bloom and his co-authors. There's a version of that index called Regulation EPU. There's also a less known paper that is about sentiment, also use newspaper coverage. Now, I think there's a big difference here, which is those papers don't really study regulation. They study, I would say, regulation-driven outcomes. Let's say the uncertainty or the attention, and that's how they try to frame this. Now, I think what the current paper is trying to do is it's a bit unusual choice, a bit of a tough spot, which is to quantify regulation itself by looking at the coverage in the news. And I was trying to ask myself, what exactly are we measuring? And I think maybe the way to think about the measure is more about the salience or the attention of the media or from outsiders, and how do they think about deregulation. Now, this is an interesting economic object. It could tell you about expectations or about sentiment, but I think it's slightly different from, or vastly different from the way it's currently presented. I want to give another example to illustrate the difference between primary and secondary. And the way I understand the filtering here is as follows. You're going to start with an old New York Times article, about 2.5 million articles published over 65 years. And then the step one of the filtering is to remove about 75%. These are articles that clearly don't talk about regulation. So you're going to end up with about 600,000 articles. And then I believe, and I may be wrong about this, but at least the way I read the paper is that 95% of those don't really talk about deregulation. These are the zero scores, the ones that don't really talk about this. So we're going to end up with about 30,000 or 33,000 articles over 65 years. If you do the math, it's about 1 article per day on average, and I suspect they're highly clustered in certain periods. What this means is that this is a very, I would say, thin or weak signal about what is actually going on. Because, if you read other papers in this literature, the federal government, I'm not even talking about state and local, just the federal government is working every day on thousands and thousands of rule proposal, deregulatory, regulatory. That's just what they do every single day. And, from 1 article on average per day, how much can you really learn about this? It's a bit of a challenge. Now, I want to, how much time do I have?
5 more minutes.
5 more minutes. Okay, that's fine. I think maybe. Now, the last thing I want to talk about is what are we going to do with this measure? Usually papers in this literature, when they introduce a new measure, they try to take another step. So one option is to think of it as regulation as a Y, so as an outcome variable, what is driving regulation, or in this case, deregulation, what is the political economy, what are the bureaucrats' incentives, partisan affiliation, all of this stuff. I think this paper leans more toward the other question, which is fine, which is regulation as the X variable, like independent variable. You have more regulation or less regulation, what is it going to do to investment or whatever you're interested in? Now, of course, in order to think more cleanly about the hypothesis, or what is going on, or why would this index connect to certain outcomes, we need to have a better understanding of what this is. And I think I talked about this before. But regardless of how you interpret the measure, I do think that in order to make this a bit more relevant to I would say applied mind or corporate finance people, it would be helpful to push the paper into a direction. The first one is I already saw in your slides, and I'm happy to talk about this offline. It's do a little bit more work on the cross-section mapping, which is rather than doing at the industry or the sectoral level, try to think of how to map it to firms. I think earning calls is the right direction. It has been done before, so we can talk a little bit more about the details. And of course, I have to mention the endogeneity questions. Whenever you have whatever measure of regulation in mind, it's never going to be exogenous. Regulation is not born out of thin air. There's a lot of reasons why regulation arrives, why exactly this deregulation wave happens. So you do want to think a little bit more of what is driving the regulation, especially here, as long as it is based on media coverage or firms explicitly talking about something. There is a reason why they do that, and you want to understand what is going on. I will say, at least this is my personal preference. I don't know how widely it is shared, that I don't think a single paper needs to solve all of that, come up with a measure, think about all the outcomes, and solve the endogeneity. Some people say regulation is a little bit like the elephant. In the room, there's surrounded by blind people. So everybody's touching a different part, and nobody really knows what is this thing that we're touching. And now we finally have a few measures that help us see parts of that elephant and understand a little bit what regulation is. So I think that's already a very interesting contribution. So I don't know if you need to solve all of that, but that would certainly be helpful if you have some solutions. Okay. So yeah, why don't we reserve that to offline? I'm going to talk a little bit. We can talk a little bit about that. So just to sum up, I think this is a very interesting paper, a lot of effort, very transparent. Everybody can use the data. Everybody can experiment with it. This is all fascinating and exciting. I do think it would be helpful to think about what exactly we're able to measure by explicit discussion about regulation. And good luck, and look forward to the next one.
Reply and then take some questions.
Thanks a lot for these very insightful comments, and for sure, the paper already improved a lot from previous discussions that we had with you at the board. So this is great. Just starting with some of your major points. So first of all, I think 90% of the paper was prompt evaluation. You write it down, and then you go and evaluate, and then you end up finding that you're capturing fiscal. You go back and then redo it. So in part of testing it and then running through the others was it's a big chunk of the paper. Why we focus on news about the discussion of the actual implementation? One of the major points here is that firms know about the regulations that will come, that will be implemented, and they do act upon it. If we look specifically at the time that it's implemented, we see kind of a delay of almost 1 year. By 1 year, things are already happened. So there's a lot of this anticipation to the future effects of the regulation that the firms need to invest and anticipate to it now. For us, our biggest validation of our measure is really when you compare to the independent measure of the Federal Register, which is just about actual implementation of the regulation. There's almost a perfect match of the spikes. So there's really this leading. Now, what is being discussed, we rely on, not just us, but several other papers that we worked on, especially on uncertainty measures, on the newsworthiness of the discussion. So if the idea is that if the regulation is important, it's going to affect the economy, it's going to be discussed at the newspaper, and maybe not just one article, but many articles about it. So we rely on that and try to capture that. So really focus on like on this news to try to capture this anticipation effect on from the firm level. I agree, not really like trying to solve everything. That's why we put all the data available so you guys can try we try to give like a tease on the empirics where it's going, and then that like results actually make sense as you would expect. Like, you know, firms invest, they do talk about expected deregulation, they anticipate that investment reacts to that, but we're very happy to any additional results that we can come out from it. And yeah, I think those are the main points.
Let me ask you, you didn't have a chance to talk about some of the heterogeneity in the results and the cross-industry results. And I was wondering, especially because of the example you gave about the casino deregulation, you know, do you find that some industries, for example, banking, you know, have a bigger impact? If there's deregulation in that industry, it has a bigger impact on the economic analysis that you do. Could you comment on the impact?
Yeah, we haven't done any more like deep into sectors on the earnings calls, right? But
And it's a very good question, the extent to which deregulation in one sector will first have larger spillovers to the broader economy, but also have maybe in some cases, there's this at least narrative out there that we are all familiar with, in which deregulation in one sector may actually cause problems in other sectors. So one of the ideas we had in mind, but we haven't done it yet, was exactly quantify the extent to which regulatory actions in one sector may spill over to other sectors. So think about the network effects of deregulation. We haven't done that.
Okay, question, this is probably an obvious one, but about, you're looking at stock returns to the extent that publicly traded firms are incumbents in an industry. It's not obvious to me that they would do better if, and that you'd expect stock prices to go up if there's more deregulation. Actually, not prior, it's kind of the opposite. It's going to be harder to earn rents, right? Like suppose you deregulate the airline industry. If you're Pan Am, that's bad news, maybe, right? It's going to be less. I don't know.
Yeah.
That was just a thought I had when I saw your stock return, because you said that's validation, but I wasn't quite sure.
Yeah.
Right.
So for sure, it's not like the direct expected, like it can happen, especially like in the early periods that it was more like towards competition. So again, like the macro effect is an average over 60 years. Right. So on average, these are like the expected effects. Even like probably like the effect on prices may change a lot, like over time. So it wasn't our, at least I didn't have any prior exactly on that. But when you look at the economic responses, that probably like takes more on this, like seeing the regulation as more beneficial for the publicly listed firms, so stock prices go up. And corporate profits as well, which is another one that's not obvious, which one you would expect.
You showed a little bit of information about regulation versus deregulation. Have you already written the same paper on the effects of regulation? Do you have any previous?
No, we haven't. So one thing also related to Joseph's comment, our initial idea was actually to create something that was like net regulation, like increased regulation and deregulation. And this comes a little bit so AI kind of gets lost if you go and ask, like, because an article may talk about regulation, may talk about deregulation and so on. So we try to focus on the direction. That's why like we have the two measures in separate. Maybe in 10 years or less, you can do something that is more like on the net one. But one thing is that increased regulation does not necessarily induce, say, like either higher economic outcomes or lower, because it may just be also like guaranteeing well-functioning of the market, while deregulation is usually understood as kind of like a tax on firms. So the initial effect is quite direct into increasing like the GDP and investment and so on. So when we actually do on the regulation, we don't find much effects on like when you like have like a shock into the regulation part. It's not the focus of the paper. Maybe we can write a second one follow up just on regulation. But what we do find is that we do control for increasing regulation when you do our macro effects. The regulation specifically, the direction is only one. It's like it's the initial short-term economic effect is quite positive.
Any other questions? Yeah, so meeting up tomorrow, same time, 1 o'clock. And.